Let's get started. Good morning, everybody. I'm Duane Lund. I'm the CEO of NEI Legacy. I'll talk a little bit more about that in a second. And yeah, like I said, we have about 80 people signed up for the in-person, but at last count, I think we were about 160 online. So to those online, welcome. Glad you're joining us, and looking forward to sharing with you the next few hours some interesting tax techniques for real estate professionals. Okay, little housekeeping first. Audio, video, I think we're good to go. For those of you online, you should be able to, for the Q&A, we'll do a Q&A at the end of each panel. You should be able to just type in your question online. It'll come into the service here, and then at the back end, we should be able to hit the questions, provided we have the time. So just type in your questions if you're part of the online group. The Cubs game, okay? So we have about 80 people going to the Cubs game tonight. If you have any questions about access or tickets, Maddie Coleman is here somewhere. And we'll see, the weather forecast keeps changing. So we'll see. First pitch is at 6:40. The suite opens 90 minutes before the game. And a bunch of us are actually going to meet at Sluggers, the bar right next to Wrigleyville, if you've ever been there. And Cliff, where's Cliff at? Here's the good news. Cliff from NEI Global, his buddy owns Sluggers. Okay, so if you head over to Wrigleyville, we're all going to be at Sluggers probably around 5:30, and then head over to the suite. Okay, sponsors. Let me start by doing a little thank you to the sponsors. So first and foremost to Team NEI Global. Jay and Cliff and the entire team in New York, thanks for promoting this event and helping us out. NEI Legacy, which is our company, my company, we'll talk about that in a second. And then Team NEI Miami, Fort Lauderdale. Jeremy Larkin is one of our speakers on the third panel, and the team down in Miami, thanks for helping out. So those are the NEI sponsors. And then the balance of the sponsors, RE Journals, thanks for putting this whole event together, at least the logistics behind the scenes. Team Anchin, we got a bunch of speakers from the Anchin team, the accounting firm in New York. Chicago Deferred Exchange Corporation, Real Estate Network, Marshall McLennan Agency, Lightbox, and then the Dallas Anthony Jeffords law firm. So thanks to the sponsors. We couldn't do this event without you. Okay. And to their NEI offices, here's the good news. We have almost 100 NEI professionals participating in the event today. And again, it's really centered around NEI. And so here's the offices that are attending in person. And then in addition to this, we have almost I think another 20 offices that are online. So here's some of the NEI offices that are participating in the event. All right, so we have several NEI clients that are participating, but we also have some potential clients, probably the best way to put it. So just a refresher on NEI Global and who we are. Here's our snapshot. You know, we're one of the big five. We have an international footprint, over 5,000 professionals, and here's the deal. We have boots on the ground in every market. Okay, so if you're an existing client, you know how to get a hold of us. If you're a prospective client, just reach out to your local NAI office. If you have any questions or your clients have questions about the presentation today, the local NAI office can get in touch with either our office or one of the speakers today, and that's the NEI Global snapshot. And then NEI Legacy, I'm the CEO of NEI Legacy, Duane Lund, and our role within NEI, we territorially, we control the state of Minnesota. So we have a full service, what I'd call traditional brokerage company that operates in Minnesota. But in addition to that, we also have a real estate tax division. Now, doesn't mean we do tax returns, but what we do is offer tax tools to our clients. And most of those tools are either deferral tools or sheltering tools, okay? So we manage a lot of 1031 money, and we call it 168 money, which is depreciation money. And we set up that tax division at NEI about 2.5 years ago. Right now we have 185 investors in the program, about $250 million of tax-deferred capital that we manage at NEI Legacy. And we have clients right now in 32 states. And that's candidly what we're going to be talking about over the next 2.5 hours, is some of these tax tools that we offer as real estate professionals to our clients. And as you learn about these tools, hopefully they're tools that you can use for your clients and to land some more business. So that's the NEI Legacy footprint and what we look like today. And the code section, I'm an ex-CPA from way back in the 80s, and those 6 provisions of the code that are up on the screen, we dance in all 6 of those categories. 1031s and 721s and 168s are probably our biggies, but those are the tax provisions that we use as tax tools. So that's NEI Legacy. And here's the lineup today, just so it's kind of set, because there's a lot of crossover with the different panels. So the first panel, we're going to dive deep into those that own real estate today and are looking to exit or pass that real estate on to the next generation. So the whole first panel is about what someone should do with their assets at the back end of their career and how they can move those assets into a tax-efficient, vehicle. So that's number 1. It's called Passing the Torch. The second panel, candidly, is all about NEI and brokers in general, and we're going to talk about broker tax tools. And the way we set it up is kind of from crib to grave, just everything you should think about day 1 as a broker and everything you should think about the last day you're a broker. And we're going to talk about all the different tax tools we use for our real estate brokers at NEI Legacy. And that'll be a fun panel. And then number 3, we're all going to move to Florida. This will be fun because panel 3 is going to be about the residency tax considerations if you're moving to other states, but also moving your tax basis to other states. That's going to be the focus of that panel. And you'll see some case studies throughout the day, but we have several clients that are moving their tax basis to states like Florida. So we're going to talk about those type of considerations. So that's the agenda. And with that, let's go to passing the torch. So let's do this. I think it's going to be easier for the panelists to just introduce themselves. So I'll just go right down. Jordan, maybe you start, do your intro, and we'll go right down the row here, and then we'll go into passing the torch.
Sounds great. Thanks. Good morning, everyone. My name is Jordan Capps with Marsh McLennan Agency. Marsh McLennan, if you're not familiar with it, it's the world's largest brokerage and consulting firm. And so we, like NAI, have boots on the ground all over the place. I'm up from Indianapolis. About 8 years ago, I sold my firm in North Carolina to Marsh, and we were acquired in large part because of our expertise working with business owners and executives. And so as we're talking about tax strategies for you this morning, for this audience this morning, this is a good part of where we spend our time working with clients ranging in size from small business owners, people early starting out in their careers, all the way through family offices that are managing large estates. So hopefully we'll touch on a little bit of those things that apply wherever you are in your career, or your clients are in their careers.
Hi, my name's Jim Lockhart. I'm a tax partner at Anchin. I've been in the real estate industry from a CPA perspective almost my entire career, working with funds, REITs, DSTs, real estate professionals, structuring tax-deferred transactions, and helping pass the wealth on to the next generation. I'm happy to be here, and thanks for having us.
Thanks, Jim. Good morning, everyone. My name is Zurab. I'm a partner also with Anchin, Block & Anchin. I began my career with Ernst & Young. I was there for about 10 years. I've been with Anchin for the last 7 years. Similar to Jim, I specialize in working with real estate funds, property owners, developers, in probably most asset classes out there under the umbrella across most legal structures as well. Anchin is a mid-tier accounting firm with about 65 partners and about 500 employees. Again, we specialize in auditing, accounting, taxation, advisory, and consulting services, with real estate being one of our larger practice areas.
Okay, perfect. Thanks, guys. So here's how we're going to attack this first panel. We're going to hit 3 different strategies. We're going to focus on that second strategy, exiting and repositioning, because it's primarily what we're doing, and it's what many of our clients are asking us to help them with. So here, to kind of set the stage before we dive into entity strategies, what's happening with a lot of our clients, maybe me and myself included, but baby boomers were retiring, right? And we're retiring out of real estate, and we've closed about $100 million of deals at our shop where we help partners that are in partnerships exit the partnership. And maybe in its simplest form, a partner wants out and a partner wants in. So we've been helping clients set up new entities and transferring that property into an entity tax deferred, and then we cash out the retiring partners and other people stay in. So to set the stage for really that exiting section of this agenda, I'm going to have Zurab go through different entity strategies and just an introduction to the different entities that we use. So I think we start there, because then when we talk about the repositioning strategies, you'll understand the different entities that we're using. So Zurab, why don't you lead off and kind of hit some of the different entity structures that we've been using?
Great. Thanks, Duane. Again, it's just a pleasure to be here. We've been talking a lot about this panel, and looking through the slides, it's a very exciting panel because there's a lot of very good information in here that I think is very important. And quite frankly, I don't think the timing could be better to talk about this, the strategy or these items today. Well, why? Why is that the case? Well, the population is aging or has aged, right? As Duane said, baby boomers are either entering retirement or have retired at this point. And those who are fortunate enough to have their own real estate portfolio, they may be looking to either move away from the day-to-day operations or of their business in the real estate, or transfer their holdings to the next generation. And given that we're starting to see some cracks, and I use that lightly, some cracks in the real estate market, and this probably includes most asset classes aside from probably industrial, then thinking about diversification and what's next in the generational transfer, whether that's selling real estate or passing it on to the next generation, right now is a hugely important conversation. And again, the real question is, well, what is next? Do you continue to hold real estate and pass it on to the next generation who may or may not be interested in managing the day-to-day operations of the business? Do you continue managing the day-to-day operations of the business yourself? Do you just sell and then stash the cash into your mattress? I don't know. I don't know what the right answer is. Maybe you just buy Bitcoin. I'm not sure. But maybe there's a different option. Maybe those who may not want to operate the day-to-day operations of real estate and their kids don't want to either, maybe the right thing is to change the structure into a different form and pass that on to the next generation. And real estate, as my good friend Jim over here says, is the last tax shelter. So staying in real estate is clearly hugely important. And if that's a route that somebody's going to take to reposition or restructure the portfolio, and Duane said, this is what you specialize in, right? This is what's happening out there. Well, that kind of depends on what structure you're in today and what's available to you in the future. So what can you actually take your money and put that into in the future? And then there is the age-old question that every real estate professional asks. Well, I sold it again. How do I defer my taxes? How do I not pay any gains, right? And Jim is a tax expert here. He can certainly talk about that. And there may be some people in this audience that may be thinking about transferring their wealth into the next generation, but there are also probably some younger people here who are thinking about, well, how do I buy my first deal? How do I set myself up for success? And how do I just enter the real estate market as a whole? And understanding real estate and real estate legal structures, I think, is hugely important to be educated to make those decisions. So with that, as Duane said, we'll start with some real estate structures. This is a very 50,000-foot level overview about what these structures look like, and everything may be facts and circumstances dependent and may change specific to your case. But I think generally speaking, this is overall a very good overview of these legal structures. So we'll focus on 6 different structures. First one being a direct ownership into real estate through an LLC. Then we'll talk about joint ventures or partnerships. We'll talk about REITs or real estate investment trusts, private funds, tenancy in common or TICs, and then we'll talk about DSTs or Delaware Statutory Trusts. And Duane and Jim will talk about DSTs in a lot more detail throughout the presentation. And thinking about these slides and thinking about what's next, REITs and DSTs, I think that's what's next. But we'll get into that a little bit more detail shortly. So what's an LLC or direct ownership in an LLC? This is probably the most straightforward, simple, non-complex structure for those who are starting out. So an individual owns 100% of an LLC. They control 100% of the property. They control 100% of the operations of the property, and all the decision making, stays with that individual. Very good first deal structure. Great way to start out, but may not be the best way to transfer real estate down to the next generation. But again, we'll talk about that in just a second. The next slide, we have joint ventures or partnerships. So this is where two or more individuals or partners are coming together to form an entity. Generally, their ownership percentage is based on how much money they put into that LLC, and then the LLC acquires the property. Again, generally, investors are liable for their ownership percentage of liabilities, unless that's otherwise specified within the legal documents. And this is a fairly good intermediate structure, so to speak, where two or more individuals can enter into a deal, take down a larger deal, or acquire a larger property while maintaining decision making over that asset. On the next slide, we talk about REITs. So REITs are a little bit more complex. A REIT is generally a corporation. I believe it's a C Corp, which elects REIT status. So REIT is a tax status. It is not a structure. It's a tax status. REITs can be public or private, and there's many REITs out there that are public. And anyone can invest into a public REIT. So anybody can go out there, buy shares of a public REIT today, sell it tomorrow, and the liquidity is certainly there. The access to private REITs is a little bit more limited. REITs are managed by a REIT manager that you see on top left, who is compensated vis-a-vis a management fee. And owners and investors are then issued shares for the investment that they put in. And again, in the public market, shares can obviously be sold at any time, so liquidity is there. The REIT itself owns an operating partnership, and then that partnership owns other partnerships and/or properties. When investing in REITs, what's interesting is that, generally speaking, corporations are taxed. So if one was to invest into a REIT, there would be double taxation. So there would be tax at the corporation or the REIT, and then at the individual level if they're receiving dividends. REITs, by electing REIT status, they avoid double taxation. So the REIT itself is not taxed, and then the individual that's receiving the dividends is taxed at their level. And well, what determines the dividend? So how's the dividend determined? How's the dividend paid? Well, it's based on two things. It's based on taxable income, and it's also based on FFO, or funds from operations. So if the properties of the REIT are generating cash flow, then clearly funds from operations that can be distributed. But a REIT must, it's a requirement for a REIT to stay a REIT, must distribute at least 90% of its taxable income to its shareholders via dividends. So if the properties are generating income, if the properties are generating cash flow, that cash flow must be distributed to its shareholders. Of course, REITs can choose to distribute more than 90%, but generally they distribute at least 90%. And there's other tests as well. They must own 95% of good assets, and there's other income tests that are out there as well. So it's a little bit more of a complex structure, but certainly a great structure to be investing into, and certainly does provide a lot of liquidity. On the next slide, we talk about private funds. Again, this is a little bit more complex. They're formed by a general partner or the investment manager, who then manages the fund in exchange, again, for asset management fees and for promote. So if the asset manager does well, and the deals do well, and there's a lot of cash flow, and the deals are sold at a later time, the asset manager gets a promoter carried interest that we all hear about from doing a great job. Funds will then raise equity from investors, and will go out and acquire more than one asset. But generally speaking, the strategy is that they're not really diversified. They're generally speaking stay in the same asset class throughout their life cycle. The decision making here is similar to a REIT, where the REIT manager maintains all the decision making. Here, the general partner maintains all the decision making ability. In certain cases, large investors that are going into a REIT may get an opportunity to sit on the investment board or the advisory board, and they may certainly make some decisions, or generally speaking, have some veto power in declining some of the investments that are being made. But generally speaking, they don't really have the decision-making ability, so to speak. Funds can be very lucrative to general partners. We work with a lot of general partners at Anchin. We have an emerging manager platform where those who have done several deals on their own, now they're really thinking about, well, maybe I need to start a fund. Maybe I need to manage some money, other people's money. I think I can do a pretty good job of managing people's money and maybe get paid on the back end. So they start a fund. They raise capital from other partners. Again, they invest into real estate. We kind of hold their hand from the day one where they had a thought of being a fund manager, all the way through raising capital, doing their first close, and then starting to deploy their capital, all the way through the end of the fund cycle. And we'll talk about that in just a second. And that emerging manager platform, Jim is my partner in crime there. We do a lot of work there. But again, as far as funds, are they the best vehicle to transfer wealth? Well, they're usually 8 to 10 years. That's their life cycle. It's a 8-year life cycle for real estate funds plus 2 1-year extension options. May not be the best vehicle to pass wealth down to the next generation because of the finite life. Next slide, we have a tenancy in common, or a TIC. It says it's tenancy in common. I don't think it's as common anymore as it used to be in the past. I don't see a lot of this, certainly. But this is a structure where individuals have a direct ownership interest in the property rather than having an ownership interest in an LLC. Both of the investors, or more than one investor, they have full liability across the entire asset, while their benefit is limited to their ownership interest. And on the next slide, we have DSTs, or Delaware Statutory Trusts. And again, Duane and Jim will dive into this in a little bit more detail. And truly, they are the experts. But at a high level, so DSTs are trusts. And there's a trustee that manages the DST, similar to a REIT manager or general partner managing a fund. Investors put their money into a DST, and most of this money comes from, or all of the money comes from 1031 exchanges. So this is where deferred gains are coming from, that are being invested into a DST, and that's being managed by an entity or an individual, by the trustee. And again, if thinking about the next generation, passing the torch on to the next generation, if the next generation does not want to manage the day-to-day operations, this may be, and the legacy generation is selling their assets and they have gains that they need to defer, this may be a great vehicle to put that money into. And let's go to the next slide, Duane, if we can. So this is my last slide. I apologize. It's small. There's a lot of information on here. But here is, we see all the legal structures across the top. So we have direct LLCs, investments, joint ventures, REITs, funds, TICs, and DSTs. And I'll cover a few things at a very high level. But again, going back to the generational and transfer perspective, so direct investments through LLCs and joint ventures are probably easy enough to transfer to the next generation. But the next generation is going to have to step into the shoes of the previous generation and continue what the existing generation was doing. So whether that's managing the day-to-day operations or whatever was being done, effectively the next generation is stepping into those shoes. They may or may not work. It depends on the situation, right? So not everybody wants to continue staying in real estate. Joint venture is very similar. The partnership interest may be transferred to the next generation, but again, the decision-making still continues to stay with that next generation, and those individuals need to stay and continue maintaining the day-to-day operations of that entity. So REITs are a little bit more interesting, and this is where the shares can be easily gifted to the next generation, and if the next generation chooses to do so, they can be liquidated fairly easily for cash. But also, they can be held, and they can be held for dividends. And again, REITs have to pay out 90% of their taxable income in dividends. And while a lot is certainly dependent on the REIT manager and how well they know the business, how well they're managing the REIT, the fees are generally fairly minimal. So the next generation can go into a REIT and continue to garner the benefits of real estate. So continue gathering, getting dividends, and pay few taxes or low taxes because, again, as I said before, real estate is a last tax shelter. However, REITs are generally less diversified. They generally maintain a similar strategy in that they stay in one asset class, by and large. Funds, we talked about funds having a finite life. So at the end of the fund's life, at the end of that 8 or 10-year life, unless that money is reinvested, that money comes back to the investor. So from a generational, and that money has to be recycled. It can go back into Fund 2, Fund 3, Fund 4, can be put into a REIT, but there certainly are decisions that need to be made, and that's not a really generational transfer vehicle, so to speak. TICs are probably a little bit easier to transfer to the next generation, but again, similar to JVs and LLCs, the next generation has to step into the shoes of the previous generation and do the same things that, by and large, what they were doing. With DSTs, and again, I'll cover this very briefly because Jim and Duane are going to cover DSTs to a little bit more detail. But if the generation does not want to participate in the day-to-day operations and the assets are sold and there's a gain on that sale and nobody wants to pay taxes on that gain, then DSTs are great vehicles to transfer those gains or transfer that capital into, rather than transferring those funds into a 1031. And now with a DST, an individual or family has the option to have that money be managed by an experienced trustee or an experienced individual who knows the business. So again, the gain is deferred. Cash flow distributions continue if the asset is performing. So again, you're gaining the same benefit from real estate, and the next generation is able to take a step back from the day-to-day operations of the business, which may be what some generations are looking for. There's limited liquidity and also limited diversification as well. But what's interesting is that if somebody was to marry a REIT and a DST together, those two could combine, could really provide for a lot of liquidity, could provide for a lot of diversification, and things of that nature that would really kind of be the best of both worlds. So, to me, DSTs and REITs, and if they're combined into one vehicle, those are certainly something to really, really think about and think about transferring wealth into the next generation.
Okay, so excuse me, let me jump in. So why does this matter to an NEI broker, just to simplify it? And here's why it matters, at least at our shop at NEI Legacy, is we have clients, and many of our clients, they've owned buildings for 10, 20, maybe even 30 years, and we always hear it, you know what, I would sell, but my partner doesn't want to sell. We hear it all the time at NEI Legacy, and I'm sure you do too at your NEI offices. And our quick response to that is, well, what if we can deliver to you a solution where we can cash out your partner or cash out you if you're the one that wants to sell, and keep the other partner in the deal. And that's where this contribution technique and why these entities matter, because we use the DST structure. Most people know the Delaware Statutory Trust is a 1031 vehicle. We use it as an entity ownership structure. Has nothing to do with 1031s on some of our deals. And so we say to that property owner, tell you what, let's contribute your property to a DST or a REIT. That's why I wanted Zurab to cover these different topics. Those are the two big vehicles for 721s. And we show the client, hey, here's a solution. And you actually can sell 40% of your property or 60% of your property. And it's a big, big part of our business at NEI Legacy. So guess what? We still get a fee because the transaction closes. And typically then we're the group that buys the selling partner out. Okay, so that's why I wanted Zurab just cover these different entities. Some of it does seem 101-ish, and most of our clients are in LLCs today or LPs. We just broke up a 1979 limited partnership in Minnesota and using the same concept. So that's why I wanted Zurab to cover these different techniques, because these are the vehicles we're using at NEI to get listings. And ultimately they turn into acquisitions. So Zurab, thanks for that. And as far as how some of this stuff lives on your tax return, we're going to cover this in section 2. This, in my opinion, matters for real estate brokers that are trying to take advantage of depreciation techniques. But obviously Schedule E is where most of these assets live if it's a disregarded entity, right? If you go buy a duplex or you own a property by yourself, it's on your Schedule E. And then the LLC that Zurab was talking about, if you own 100% of it, it's a disregarded entity. It doesn't file a tax return. So it goes right to your Schedule E. And then obviously if you have partners, you're doing a Form 1065, which delivers K1s. And then REITs, as he mentioned, it's actually a C Corp that elects REIT status. And then the DSTs, one thing we do like about them, we have, what do you know what our head count, we may have 30 of them in our organization now. They're disregarded entities. Okay, so again, it doesn't file a tax return. Instead, it lives on your Schedule E. So another thing we like about it. Okay, so now that we got the entities down, let's actually do some case studies, and Jim and I will just talk about how we're actually closing these deals with our clients and helping them out. Obviously, there are those that are just selling and paying their taxes and moving on. I mean, I'm a baby boomer. It's interesting how many of my clients and buddies, probably a better way to put it, have just said it, you know what, I'm going to pay the taxes. And they sold the property and paid the taxes, and that is what it is. Obviously, we're not going to spend much time on that. But we have some clients that actually, their comment is, Duane, I don't think the tax rates are going to get any lower. So they actually sold and pay the taxes. So obviously, we won't spend time here. But now let's talk about selling and deferring in the two techniques, and maybe Jim, you can jump in. But in its simplest form, we have clients that are selling, right? They're actually selling, and then they want to do the deferral afterwards, which is the 1031, or the 721 has become a big, big part of our business model where they're contributing their asset to a new entity. And so the 721 allows them to keep kind of skin in the game with the building they've owned forever, but defer their taxes. So 721s in our industry, most people know them as an UPREIT, Umbrella Partnership Real Estate Investment Trust. Just so you know, the 721 code, that's a partnership provision. It candidly doesn't have anything to do with real estate. It's just a tool that's used by real estate professionals, kind of started in the late 80s, Jim, when the first UPREIT was done by Taubman out of Michigan. But just so you know, the 721 provision is a partnership provision, and so you can contribute to a REIT, but you can also contribute to a partnership, a DST. So let's, Jim, maybe jump in and talk about 1031s and 721s. Do you want to start with DST? Jump in a little bit?
Oh, sure. So, yeah, like Duane said, so many of our clients everywhere just want to sell or, but they don't want to pay the tax. And so, 1031s have been around for a very long time. We work with a lot of clients with 1031s. I think the key in doing a 1031 is getting a really good qualified intermediary to work with you to help navigate the waters, all the timing considerations. You gotta, you really need to get a really good team around you. Going into a DST, I think if you don't want to manage property anymore is a really good solution because they can accept 1031 dollars. And what's really nice about that is that if that person or you don't want to manage anymore, you have a trustee that's knowledgeable about the property and can make those decisions. And honestly, you just go to your mailbox and pick up the check, basically. And you can defer that. What I love about the DST, especially when it comes to 1031s, is that if and when they sell that underlying property that's in a DST, you as a beneficiary of that trust, so a DST is a grantor trust, and everyone who's invested in it has that beneficial interest. And so if that underlying property is sold, what happens then, you now have the choice to whether or not you want to go and do a 1031 with your proceeds. You can take the cash, pay the tax, or you can roll it into another DST vehicle. And that's a very powerful tool. And then, we have clients that have done that, and they've done the 1031s, and, when they pass, there's a basis step up, and then you get to do it all over again, with depreciation and so forth and so on. But that's really I see one of the main benefits of DSTs, and I talk to all of our clients about setting up DSTs. Whether you're a developer or an investor, and I go to our developer clients that, develop, build, and hold, and they raise money. It's like, well, why do I want a DST? Because they want to talk about trading their profits when they sell the property into another project. And the issue with that is when you're in an LLC, you have to get everybody on board to say, yes, I want to do a trade. Now I say, well, how about the drop and swap? Drop and swaps have become very risky. I've personally never done a drop and swap. And the issue becomes because when you do a drop and swap, a lot of times if they're not simultaneously, a simultaneous transaction where they do the drop and then they do the swap the same day, or maybe they wait a month, the IRS doesn't like it. And the way the K-1s are now, you're basically putting down all the information the IRS needs to see that gives them a roadmap to your drop and swap. And the issue with the drop and swap is that a LLC interest, a partnership interest, does not qualify as like-kind exchange property. But you say, but now I own the building, so why doesn't that qualify? Because the IRS likes to see at least a 2-year hold period on that. And if you're doing a drop and swap and you have to own that real estate for 2 years, well, it really doesn't work. And we all know people that have done them and have not been audited, but I promise you there's a fair number of people out there who have done it, who have been audited, and have lost. So it's a really risky transaction. But when you start out with the DST and you put your property in there, when you sell, a developer can now take their proceeds and roll it into their next project. And that's why I feel these are such excellent structures for people to go into. Now, you've heard about 7 deadly sins, and there's things that you have to be careful of. And there's ways to structure around that if you have a really good attorney who knows DSTs. So, again, it's a really great tool because now if you've owned the property, developed it, or whatever, you don't lose your tax money, that you would otherwise pay. You can roll it into your next deal. So they're becoming very popular. We're structuring a lot of those for our clients now.
Yeah, and this slide here just shows the DST capital that has been raised since 2010, but if you look at it, most of it's been raised the last 2 years, almost half of it. And one thing about this DST space, this is the equity raised by broker-dealers. Okay, so this is the securitized space. This does not include equity that comes from the real estate community or from NEI brokers or brokers in general. But it's an interesting game. We're in the game at NEI Legacy, but it's also a little bit of a who's who. So like Hines as an example, Hines, they actually have a DST platform. JLL has a DST platform. Inland here in Chicago is a large player. Cantor Fitzgerald's in the space. So it's kind of a who's who of players that's offering these securities as DSTs. And proof of concept is behind us, if you will. And you can kind of see how the graph is. And so a tremendous amount of equity going in these DSTs. But again, another tool you can offer to your client that's thinking of selling their building and saying, well, I'd do it, but I got to find a 1031, as opposed to buy an individual property. He or she could actually just buy a portion of a DST. And so there's always inventory out there in the DST space. We don't have any offerings right now at NEI Legacy. But the beauty of it is you can match it to the penny, okay? So even if the 1031 seller has $100,000, or we had a client with $14 million that put it into our program, you can fit it into the DST program, okay? Because you can buy a portion of a building versus the entire building. So a proven market, gets a lot of press, and a good way, again, to get a listing, just say, hey, I know someone that does DSTs, a good way to get a 1031 done. And we kind of already hit it in its simplest form. Jim talked about it, these DSTs. Again, Delaware statutory trusts have been around, Jim, maybe 100 years or so. It's just that recently, 2004, there was a revenue ruling that deemed a DST interest to be qualified property under the 1031 rules. Okay, and Jim mentioned this 7 deadly sins. We're not going to go into that today. But in its simplest form, if you're a shareholder, I call it more of a shareholder, but a beneficial owner of a DST, whether you own 1% of the DST or 50% or even 100%, it's deemed to be real property. That's the beauty of these DSTs. Okay, let's talk about 721s because we do quite a few of these 721 deals. Obviously, we talked about the UPREIT. We have a lot of clients that call us and say, hey, Duane, I'm thinking of doing an UPREIT with a REIT, so we kind of walk them through it. I was involved in the REIT industry for 15 years, so pretty familiar with UPREITs. But Jim, do you want to maybe hit a little bit just what's going on in the REIT space in UPREIT and people's UPREIT options?
Yeah, I mean, there's, REITs have been around. We do a fair amount of work with REITs. REITs, especially the private REITs, really count on people coming in with their properties. That's how they go out and attract, investors or, to build their portfolios is for people to contribute. And I've worked with a number of clients over the years that, I own 5 or 10 buildings or whatever, and I don't want to manage them anymore. So what am I going to do with them? Well, they're looking for a structure where they can still have ownership in real estate, spread their risk, have someone else manage it, And, a private REIT, or, if you can find a public REIT that'll take your property, that's a really good opportunity. But there's a lot of issues that you have to consider going into it, because you have debt allocation rules, you have 704 issues, built-in gain issues that you really have to manage and watch out for. But it is a very good vehicle for someone who wants to stay in real estate, spread their risk, and have someone else manage it. And a lot of these folks that we know that we work with that have a wonderful portfolio that performs, and they want to keep it, and we can help them transfer it tax-free. It's a beautiful deal.
Yeah, just some of the bullet points here. The public REITs were mostly formed in the early 90s using the UPREIT technique. Not too many of the public REITs do UPREITs anymore.
Right.
Candidly, because they don't have to. They have access to capital. They've gone very institutional with their ownership structure. So candidly, they don't want buildings that are 10 or 20 or 30 years old. So a lot of the public REITs are not active in the UPREIT space. Private REITs, there's a few out there doing them. The challenge, I think, for most of our clients, they own diversified portfolios. And most of the private REITs are property specific. So they only want multifamily, or they only want industrial. So it's been a challenge finding private REITs that can accommodate some of our clients. Some of the DST sponsors have their own REIT, and so they're rolling 1031 money into the REIT. But again, you do a 1031 first. And the retirement REIT is actually an NEI product that's going to be coming out this fall. And that NEI retirement REIT that we're doing at NEI Legacy, it's diversified, and it's kind of people first, property second. And what we mean by that, we're setting up different umbrella partnerships to match the diversification of the portfolio. So we'll have an industrial UPREIT, we'll have an office UPREIT, a retail one. So it's a way for someone with diversified product to get into a REIT platform. So that's the retirement REIT, something that we're coming out. We were going to bring it out last year, but the REIT market, not a good time to raise money with the REITs, but should be coming out next year. All right, we got to keep moving on. Here's just one profile by way of our 721s. This is one of our clients, small retail center in Minnesota. They were looking to sell, and the issue was, I can't remember how they had 13 investors in this deal. They'd owned it for 20 years, and guess what? Some wanted in, some wanted out, and they had a major tax problem. So we actually helped them get the listing by doing the deal for them. And so what they did is we took that property, it was in an LLC, and we put it into a DST. So for a moment in time, all 13 of those investors were in the DST, and then our group, NEI, I think we bought like 60% of it. So we bought out the people that wanted out of the deal. So we own 60% of it, and then 40% is some of the legacy investors in the deal. But for NEI, we were able to get a fee because we helped some people exit, and now we actually own part of the center. And buying a percentage of a property, typically you get some pretty good economics on the buy side. So we do a lot of deals like this, and if you have any clients in your NEI portfolio that have the same situation, bifurcated ownership, just give us a call, because we've got this thing. We've done quite a few deals this structure. All right, we got to get into life insurance and succession. So incorporating life insurance into the portfolio, something I've done, a lot of my buddies have done. And Jordan, why don't you take it away and talk a little bit about life insurance?
Sure.
And real estate.
Sure. So why life insurance? So let's change the title to this slide and say it's the tax-free transfer of capital. That's ultimately what life insurance is. So in this context, and let me take a quick step back, because everything we're talking about so far, plan A, right? This is what investors want. This is what your clients want. Maybe this is what you're doing yourselves. This is your plan A. And so you want to execute on everything that's been discussed so far. Then there's the question, but what if? So 8 years ago, lost my brother-in-law to cancer. He went through a 5-year battle. And towards the end, he was an engineer by training. He was the most organized dude in the world. And so he had a notebook, and it mapped out all their finances. And towards the end, he wrote a new section called Plan B. No one wants to write Plan B. No one wants to have Plan B. But the truth of the matter is, when my wife's sister said, "Am I going to be okay?" I said, "Yeah, you've got Plan B. And guess what? It's funded by life insurance." So in that moment, it brings work and life together. This is Plan B, but it complements Plan A that's being discussed so far. So take care of your family, take care of your business, save for a rainy day. That's what I mean by protection, succession, retirement. All right, let's go to the next slide. So in this context, sorry for all the words on the slide. At least your screen is a lot bigger than our TV up front here. But we just start with the question, how much coverage do you need? What are you actually insuring, right? So if it's your family, what's the exposure there? What do you need to provide? What are your clients looking to protect there? Because the truth of the matter is, you might have an asset that's not that liquid. Guess what provides immediate liquidity at the exact moment that capital is needed? Life insurance. So, and what are the tax benefits of it? It's tax-free. It's pretty good. How much do you need? Who's it protecting? What's it protecting? For a lot of our clients, they're business owners, and they're not solo practitioners, right? They're out there with partners, and how many times has someone already said this morning that partners didn't all agree? They didn't all want to sell. But in a moment where you need access to capital and you need liquidity without disrupting your portfolio, that's what life insurance is used for. And so clients buy this all the time to protect each other. And depending on the context of the business, we can structure it different ways. But that can be a very simple thing. And sometimes it's a simple 10-year term insurance. Other times they're looking at this as long-term estate planning. It can go either way. But you start with how much do you need? Who are you protecting? After that, we figure out what type of insurance. There are a range of tools in the belt, but a life insurance product is just a tool. So I'm not here saying term insurance is the best, whole life, it doesn't matter. It just depends on the context. Once you know how much insurance, then funding. A lot of times, life insurance 101, right, you're paying out of cash flow. Whether it's your own for yourself or your family, you're just paying out of cash flow. That's no problem, that's simple. Same with a business. Pay out of cash flow, pay as you go, no big deal. When you start getting into more sophisticated planning scenarios, that's when you're looking at ways that you might be able to use gifts, either your annual exemption or your lifetime estate exemption, and start planning there. What does it look like? So if you have clients that might be planning for large exits, this is where a more sophisticated approach to life insurance planning becomes very important. Because again, we started with life insurance, it should be a tax-free distribution of capital. But if it's not set up right, if you have an ultra high net worth client that keeps the life insurance in their estate for some reason, now you've just added to their estate. You don't want that. You need to get it out of the estate, which leads us to option 3. How do you deploy it? Who's going to own it? Again, life insurance 101, if it's for your family, a simple scenario or a simple business, the family will own it, individual there, or the business can own it, no big deal. But there are plenty of situations with high net worth clients that you need to have a trust. You need to have something outside of the estate that's going to own it. That also, you have to plan how you're going to fund it. Because just because you have the box to put the life insurance in doesn't mean that all of a sudden it can pay for it itself. So how are you going to generate the cash flow that box, that the trust is going to need to fund life insurance? Well, that's the beauty of real estate, because now you have a revenue-generating asset that you can transfer in part or whole into a trust, as an example, and now you can pay for life insurance. It doesn't only have to pay for the life insurance, but that's something that you can do with the proceeds that come from that asset. And so now what you have done is you've taken life insurance that's going to provide a tax-free transfer of capital at the exact time that you need liquidity without messing with your portfolio. You've given it unlimited funding, or sufficient funding, we'll say, and it's not going to mess with your client's estate planning either. So that's how and why life insurance is used in conjunction with these strategies that we're discussing right now. And again, these are things that we're doing with clients, whether they're early in their careers and they're just starting, because their plans are to have much more liquidity in years to come, but they haven't had time to build that up yet. Or for those who are later in their careers and planning for multiple generations to come and how to transfer assets there as well. That's the beauty of these strategies. Let's go to the next. So simple example, and we really have already talked about this. The one point that I will add here and mention is if somebody already has life insurance and they want to transfer it into a trust, totally do that, no problem. There's a 3-year look back. So if something happens in those 3 years, it's pulled back into the estate. Just because you've transferred it doesn't mean that it immediately is permanently outside the estate. So the ideal is to set up the trust and then have the trust buy the life insurance. Then from the very get-go, it is outside the estate. Just a planning thing, because I know that there are individuals who say, I already have this, it'll be easier not to go through it again. I agree with that. Nobody enjoys a life insurance application. I don't enjoy a life insurance application. But it's not necessarily as easy as just making the transfer. We've talked about trusts paying the premiums and multiple ways to structure that. Transferring in assets, you can fund it with loans. You can have a private loan, you can have a third-party loan. There are lots of different ways to do it. You don't have to do it all out of cash flow. I know this is an audience that is comfortable with leverage. So leverage can be used there. There are other audiences where I have this conversation and we cannot use that word. They run. But you have a lot of flexibility with the funding here too. The last slide. So this is just a quick example. Saving for a rainy day, right? It's not always what happens if your process, if your plan is interrupted. Sometimes you say, I've had a fantastic career, I need something for the future, but I want out of what I had before. There are a lot of clients that have a liquidity event and they end up with a sum of capital that they want to redeploy. And in part, life insurance could be that solution. Because with cash value life insurance, you put the money in, it grows tax deferred, and then you take it out tax free. And so this is just a quick example of someone putting in 860 grand spread over 15 years and then taking out 2.6 million in retirement years. Again, that's 2.6 million tax-free in retirement. Like many other things, time value of money applies. Starting earlier, starting when they're young and healthy, much easier than starting late in life. But these are strategies that can be used really at any stage of one's career. So again, as an example, why life insurance here in this context today? Because when individuals are planning for tax mitigation, this is a tax-free distribution and transfer of capital. It is not the primary plan, but it can be a plan B and it can be a complementary plan that provides more freedom and flexibility for the future. So business owners and those who need to take that additional step for a more sophisticated solution, life insurance is used in these ways on a regular basis.
Yeah, good stuff. And we do business with Jordan and the Marsh firm. We're starting to see life insurance work its way into entities for the first time. And the entity actually buying the policy. And then the other thing to think about from an NEI perspective is key man policies. And I've seen it now where partners, broker partners, they'll buy key man policies on each other or members of the team. And that's a pretty popular technique now, key man insurance for brokers and for owners. We have it built into our company. So if you have a partner, not a bad way to just set up a little key man policy with someone like Jordan. All right, so let's do this. We're going to run out of time. So we also talked a little bit about the donating and gifting of real estate. We decided not to dive deep into this today. But just so you know, if you have clients that are exploring the donation of real estate or the gifting of real estate to a university, to a charity, we know it. We know some of the laws, and of course the Anchin team can help you out. So if you have any clients looking at it, just let us know. Different things to think about, but there are individuals who will take appreciated real estate and donate it to a charity, much like you would donate appreciated stock. Okay, and that's a charitable contribution. With appreciated real estate, you can offset 30% of your income. versus 60% if it's cash, but you could still offset almost 30% of your income and then carry forward the additional contribution. Donor advised funds, we were going to dive deep into that, but we again don't have time. That's a really interesting concept for real estate owners. You actually set up your own fund, your own charity. You can read about it. The Musk of the world and Zuckerberg and all those high net worth individuals, they set up their own charities. And they set it up with a donor advised fund. And I've seen real estate people do the same. So you set up your own charity, you donate the property to your own charity, and guess what? It's a contribution. And then the charity sells the real estate and you don't pay taxes. Okay? So donor advised funds, they become very, very popular. You can set them up at Merrill Lynch with $100. Pretty crazy. So we're not going to dive deep into that, but if you have clients that want to know about it, just give us a call. And then same with this whole section here. This is more, I own property and I want to give it to the next generation. So you don't want to sell or do the contribution that Jim and I were talking about. This is more, I'm going to pass it on to the heirs and what's the most tax efficient way to do it. And again, we're not going to dive deep into it, but if you have any questions about any of these items, just give us a call and we can go through it. The one thing about handing it off to the heirs, the one code provision that you'll hear people say defer, 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 die, and that's section 1014, right? We all get basis step up at the back end, which is the most effective tax tool to get around this depreciated real estate. And some of these gifting ideas to your children or to your heirs kind of defeats that purpose. Okay, so a lot of the structuring that Jim and I were talking about, these 721s, is to preserve the basis such that we can get basis step up later in life. And that's section 1014. So again, we're not going to dive deep into that. It's just, that could be a panel in and of itself. Okay, so with that, this panel's kind of running out of time, but let's do a Q&A. If we have any here, let's start with the in-audience. Yep, go ahead.
For Jordan, going back to the insurance, the way you hold it, were you saying, like, say you form an islet to hold an insurance policy, but for the individual properties, say you have two partners, would you buy insurance for that LLC to hold? And if one of the partners do pass away, how is then those funds in that LLC handled? Would both partners acquire those funds, or would it be dedicated to one?
Sure. So you can.
So let me repeat the question, Jordan, just so that so the question was, irrevocable trust holding the policy versus an LLC holding the policy. The LLC owns real estate, so should the LLC buy the insurance versus the irrevocable trust? I think was the question. So with that, go ahead and answer it.
Yeah, the irrevocable trust is going to be used to get the life insurance outside of your estate. And so that means it's irrevocable, you can't pull it back, and that's why the IRS is going to say, we're not going to tax you on that life insurance. Estate planning purposes, irrevocable trust, ILET. For business owners, when there are two business partners, a lot of times the easiest scenario is just have one partner buy the policy and own it on the other. And so it's the two individuals. And if something happens to the other one, the owner of the policy receives the proceeds tax-free. So if you had multiple partners, that's when we might look at a corporate structure and then have it owned by the company. Or there could be other scenarios, but if you have two partners, most often, each one owns a policy on the other.
And Jordan, if the policy is purchased by the entity and the entity receives the insurance proceeds, it's then taxable to that entity. Is that correct?
It's tax-free. So if the entity paid for it, it would be received tax-free to the entity.
To the entity.
And then the entity could use it as operating capital. It could use it to fund a buyout, could use it for recruiting new people, like whatever it needs. It's operating capital. And so the entity has freedom and flexibility. Now, if the entity starts paying people with it, that's when it can be taxable to those individuals. So that's why, going back to the first part of the question, if you have two business owners, just have each one own the other. It makes it super simple. They get the money tax-free.
Yeah. Okay, other questions? Yep. Yeah, good question. So the question is, how are we doing the marketing at NEI Legacy? Candidly, a lot of it's word of mouth. The word's out that we've been doing these transactions. We do stuff like this, seminars. We have flyers, brochures. We work with a group in California that is a registered licensed securities group, so we do some advertising, not advertising, some work with that group. But a lot of it, at least in Minnesota, where a lot of our clients are from, the word is spread that this is kind of what we do and we can help you out. So we get a lot of calls just from the network up in Minnesota. But, you know, like one of my buddies at Merrill Lynch once said, never turn down a microphone. So whenever we get a microphone, we'll grab it and just talk about it and try to promote the concept. And all the brokers know about it. I'm the old guy in the shop, but the LinkedIns and all these pages that my team sends out, I know they talk about a lot of DSTs and 1031s. But what is interesting about DSTs, to your point, not too many people are talking about them. It's a big industry. It's a quiet industry, partly because it's in the securitized world more than the real estate world. So we got to get more real estate people involved in it. Yep, go ahead.
On the deal, you kind of recapitalized that retail center in your example. You mentioned about charging a fee, I guess, from the brokerage side of the company. So that there's no, you know, how do you get around the kind of conflict of that and then being on the investment side of buying your?
Yeah, good question. So the question is on that property we worked on in Edina, you know, the brokerage fee, the sales fee, let's call it, versus the fact that we also were principals in the deal. Now, I will tell you this, the managing partner of that partnership, I go back with him almost 30 years, okay? So that made it a little bit easier. We went to school together at the University of Wisconsin. But that said, at the end of the day, we valued the center, and that's how we deemed the sales commission, which was a contribution commission, but it was based on the contribution value. And then obviously as principals, we're looking at what we're going to buy the individual investors out at, and that's usually a different price. Okay, so it's almost two separate negotiations. The contribution fee, the brokerage fee, versus the fact that we actually bought out a lot of the partners. So we just separated the two. It is a conflict, candidly, because we're both a principal and a broker, but you know, just deal face up is how we've dealt with it at NEI. Okay, more questions here? Spencer, any online that we should try to hit, or are we kind of bumping up on time?
We're good on time.
We're good? Okay. All right. Oh, one more in the back. Garrett?
Tied back to the life insurance comment. So as a broker, let's say I'm working with two different clients, one of manufacturing companies considering a sale leaseback on their industrial building. That's the only asset that the family or the owner have. When, as a broker, real estate broker, I don't really get compensated for life insurance, but when would I make that suggestion, or how does that come up in the context of a discussion so I can get smart, still win the listing, get the sale, but yet still benefit the owner?
Sure. A lot of times when it's a single transaction like that and all the assets are tied up there, the question is, you know, what happens if the transaction over however many years is disrupted, right? Am I understanding your question? So,
Really, at what point does that life insurance
yeah,
option come into play for this owner where I can look smart, but still my goal as a broker is to get the listing, if you will.
right. Yeah, I mean, early on, when they're looking at making that that transaction, so they would want to do it earlier rather than later, and that way they have the protection in place in case something disrupts it in the years to come.
But the same benefit applies to that owner of one asset versus, let's say, a multifamily owner that has, you know, 10,000 units or something like that.
Sure.
Different class of owners.
Yes, yeah, and I know the examples that I gave are different scales, but there are individuals who are coming in with, whether they're earlier in their career or not, they're coming in with limited resources, and it's a small transaction. On my team, our agreement is we will help any client, so we don't have a minimum transaction size, but it makes a lot more sense when the economic risk is higher. Obviously, the exposure there is more significant, but you could do it at any scale.
Yep.
Going back to the retail center, not on the brokerage side, but on the partnership side, are you discounting that property if you're coming in and say only buying 40% of it, at lack of liquidity, we don't have control?
Yeah, good question. So when we're buying a partial interest in the real estate is really the question. I'll tell you, it's been different for every deal, but on average, we'll buy a fractional interest in a building anywhere from 70 to 90 cents on the dollar. And candidly, the exiting partners get that. They understand that because they just want out for whatever reason. And yeah, that is one of the beauties of buying a fractional interest. Yep.
Regarding the fractional interest, so let's say Kevin and I own a property together, Kevin wants out, but I'm a control freak and I want to continue to manage and do the leasing and do all that. So are you guys going to buy his interest?
Yeah, so
Or you have to have management, the brokerage, the development?
yeah, good question. So the question is, when we're doing these contributions and buying out partial interest, what happens to property management and leasing? And again, different on every deal. On that particular deal, Chris is the gentleman's name. He still does the management and leasing. So we didn't make that a condition of the deal. Okay, so it's all different. So if he or she that wants to sell or stay in the deal wants to continue managing and leasing, we usually don't have a problem with that. In fact, we kind of like it, right? Because it's a continuation of the same property management and leasing team. So we don't make that a condition of the deal, typically. Say it again, Michael? Yeah, we actually, which is true, our brokerage team made a pitch to lease it, and the group, which included me as the owner, voted against it. It was just because it was we thought a better team to lease it. Let's say it that way. Yeah, and again, it's people first, property second. That's the philosophy. The beauty of these partial interest deals, we end up with partners, and so we bring the partners in. All right, let's wrap this one up and get to panel. Thanks, everybody on this panel here. Good job. So we're going to break for 5 minutes, and panel 2, if you're on panel 2, come on up. Thanks, guys. Thanks, Jordan. All right, let's keep this moving. Broker tax tools. So this is for all, well, the majority of the crowd are brokers. So we're going to broker tax tools. Todd Phillips is one of our speakers. Todd is going to be calling in. He's actually up in Minnesota, so hopefully we'll hear from him. He's at the back end of the presentation. But anyway, let's do this. Ryan, why don't you introduce yourself since you're new to the panel, and Dustin, and everybody's met Jim. But go ahead, Ryan, just do your quick intro.
Hi, Ryan Paquin. I'm a director and leader of the cost segregation program at Anchin. I'm based out of New York, and I joined the firm earlier this year.
And Dustin?
Dustin Jeffords, Jackson, Mississippi. I'm a tax attorney with Dallas Anthony Jeffords. Our practice is focused on, helping legally reduce taxes for business owners and real estate professionals as well.
Okay, so here's the agenda. Now, this is a presentation we've made in the past, and it's all about broker tax rules or real estate professional tax tools, and mostly designed this presentation for brokers, the NEI brokers. But if you're a real estate professional, how you can take advantage of the tax code to shelter some of that income. And the way we kind of set this up, we wanted to cover, from day one. So if you're a new broker at NEI, what should you do? Because most of the brokers at NEI are independent contractors. So your entity structure, should you set up an entity, not set up an entity, how it gets reported. And then as we go through this presentation, we're going to start talking about tax tools as you become a producer and making more money and how you can maybe shelter that money. And then at the back end, we're going to talk a little bit about creating balance sheet wealth versus income statement wealth as a broker. So hopefully this will spark some thoughts for all the NEI brokers that are listening in. But let's start with this. So Dustin, it's day one. I'm fresh out of school and I got hired by NEI. And I need to think about my entity structure and what I should do. And why don't you lead off with broker entity considerations day one?
Yeah, absolutely. So the question on when is the time to set up an S corp or continue being just a straight LLC or running it sole proprietor style is difficult due to there being people from a lot of different states here. So it can be state by state specific. I was talking to a gentleman out there just a little bit ago and mentioning the laws in Tennessee, for example. Everybody thinks that you need to be an S corporation kind of everywhere in the country to avoid self-employment tax, but you have to factor in other types of tax as well. In Tennessee, for instance, they have a franchise tax that's 4%, which ends up being more than you would save if you were to go to an S corporation. So you have to factor that in, but just kind of broad spectrum. Having that S corp does help you save on employment taxes, on payroll taxes as well. It also gives you some asset protection that you just don't have in a normal LLC or being a sole proprietorship. It also gives you the flexibility to, write off things, depreciate a vehicle, things like that that you just can't do in an LLC or in a sole proprietorship. So it gives you some flexibility there. But in my estimation, somewhere around that $100,000 to $50,000 mark of 1099 income would be the point that you want to kind of flip the switch and change to an S corporation. You want the savings to be more than it costs to file the tax return, the 1120S, which is what you have to file for the S corporation. So that's kind of the break even in my estimation, is right around that $50,000 mark, to make sure that you're saving more than you're going to pay for the tax return.
And Dustin, the self-employment tax at an individual level, if you're at 1099, I think it's like 160,000 of is subject. That's your max.
That's right.
Correct. Yeah. And so when you say 50,000 is maybe an area where you'd consider an S corp, it's not limited just to the tax benefits.
Certainly, it's not. Yeah, and the reason I say 50,000 is because kind of where our practice area starts looking at, or my firm starts looking at it, is the benefit to an S corporation is you can set yourself a reasonable salary. That reasonable salary can be dependent on the market. We normally run a reasonable compensation report to determine, what a reasonable salary for somebody in your area would be. That is subject to that self-employment tax, right? But all the distributions that you take, so anything above that reasonable salary, you don't have to pay the 3.8% Medicare tax on, and you're saving yourself on those payroll taxes. So that's kind of the consideration that I was talking about, looking at around that $50,000 mark. Set yourself a $30,000 salary, pull the rest out as distributions, and you're saving yourself 3.8% on that $20,000 difference.
So maybe, and we didn't put a slide together with the numbers, but here it is in its simplest form if you're an NEI broker, is, as you know, you get that 1099, which I'm assuming most of you put it on your Schedule C. So I'm not a broker, so I don't report this way, but if it goes on your Schedule C, I think the self-employment tax is 15.4.
Yeah.
I think at this point. So anyway, you're looking at about $25,000 max of self-employment tax if you put your income on a Schedule C. What Dustin's referring to, if you set up an S corp, you now make yourself an employer, and your employee is yourself. And the beauty of doing it that way, as an employer, you actually still pay with different categories, almost that same 15%, but half of it is tax deductible. Okay, so that's the economic benefit in its simplest form, is especially if you make more than $160,000, put it on your S corp. As opposed to paying $25,000 in self-employment taxes, you'll actually write off about 12 of it on the tax return. So that's the economic benefit of setting up the S corp. Here's what I think the business benefit is, and it's the same way that I'm set up. So I have an S corp that's been around now for almost 14 years, and it's where my advisory and consulting income is reported. And same thing, I employ myself. That my entity is the employer, I'm the employee. And one thing about doing the S corp versus having an LLC. Now the LLC, if you own it 100%, remember that's not a tax reporting entity. Okay, but if you do it as an S corp, you have to file a Form 1120. And the beauty of that, in my opinion, is you now, over a period of time, assuming you have some recurring revenue, and let's assume you start building a team, you now have an entity you can monetize. Okay? And monetize meaning if you can show recurring revenue, guess what? You can use that entity to get a life insurance policy. You can use that entity to maybe get a line of credit. And probably most importantly, and we're going to talk about at the back end here, if you have an S corp that has recurring revenue and you're looking to exit, you sell the entity. You sell the entity, and maybe you stay on board as a consultant or chairman of the board. But I think creating a tax reporting entity for brokers, I think it's a big deal. I think it's a big deal at the back end on the exit side. And so there's the protection Dustin's talking about in sheltering your self-employment taxes. And talk a little bit about just mitigating lawsuits and risks there with entities, Dustin, just because I think that's the other non-economic benefit.
Yeah, certainly the asset protection benefit to the S corporation, like I talked about in most states, is certainly important and needs to be looked at. piercing that corporate veil, it's difficult for especially, the car wreck lawyers, things like that, the ambulance chasers, to pierce that corporate veil of an S corporation. So you're sheltering your own assets, right? You're kind of, it's its own separate living, breathing thing when it has its own tax ID number and files its own tax return, and it kind of separates, your personal assets from the assets of the corporation. It's why, a lot of people, a lot of times when you guys are doing real estate transactions for clients, you probably advise them to put it in its own LLC, right, and keep that separate from the business, again, to try to segregate those liabilities. So this would work the same way for you guys, having the business in its own corporation with its own tax ID, with its own tax return, shelters your own personal assets.
Yeah, and so Dustin has set up entities for several NEI brokers. Just give them a call. Again, I think the fresh start right out of the box, maybe they don't set up an S corp initially, right? But there's a point in time when you have enough revenue coming in, I think setting up a tax reporting entity makes a lot of sense. Not that expensive to form. You do have to file a tax return, but then all that income is reported on a tax reporting entity. I'll just tell you that banks, that's what they like to see when they're doing business loans and lines of credit. So I think there's a lot of non-financial reasons to do it in addition to protection. Okay, so now the big question under the code is a real estate professional. Now, obviously, we all in this room deem ourselves to be real estate professionals. When someone says, hey, what do you do? I'm in real estate. But from the tax side, the IRS has a different definition, just so you know. And I would tell you that probably half of the professionals in our industry don't qualify for real estate professional designation under the code, okay? And you need to get professional designation under the code, and the code being the Internal Revenue Service code, to get deductions. So we're going to talk a little bit about the definition of what it means to be a real estate professional. So when you complete your 1040, I think now it's on page 2 on the bottom, it says profession. Okay, if you don't type in real estate professional, start typing it in. That's what you want to be deemed as a real estate professional. But let's talk, Jim's going to cover the way the IRS code looks at a real estate professional and why it's important. So go ahead.
Thank you. So, like Duane said, a lot of people in this room and watching probably already do qualify as a real estate professional, but those who are starting out in this industry, it's like, well, how do I do it? And what do I need to do? So you want to go to the next slide here real quick. So basically, to be considered a real estate professional, more than half of your personal services have to be in trades or businesses in which you materially participate. So what does that mean? Well, you have to perform more than half your time has to be spent in that, but then you also have to perform more than 750 hours of service in that area. And so, it's like, okay, I do, but, I also have a lot of different things going on. I'm a broker. I also want to buy other real estate. I want to own my own assets. I may start out buying apartments, condos, something in order to do this. And so I'm really spreading my time around. And so you need to keep track of your time, and there's different ways of doing that, but you really need to spend 750 hours of services in these real estate trades or businesses. It's on the next slide, and we'll get to it, but in order to do that, you have to...
I'm sorry, did you want the other slide?
Yeah, let's go to the other slide. So you have to be more than a 5% owner in the trade or business in which you're performing these services. And so I've worked with a lot of brokers. We work with a lot of brokers, and they may not own 5% of the entity in which they're performing these services for. So it can be hard to do that. And so it's probably not until you get out and start acquiring other assets for yourself, real estate assets, that you'll be able to do that. If you're married and you're starting out and you're acquiring other assets, your spouse can qualify as a real estate professional. And we work with a number of people who, do that as well. And so the beauty of that is getting your spouse qualified as a real estate professional. Now, when you take advantage of all the tax opportunities that owning real estate provides, your spouse is qualified. We generate all these losses through the ownership of real estate, and now we can use those losses to offset your W-2 income that you're getting from your employer. So that's something to really consider and think about. So qualify your spouse as a real estate professional, and so in doing so, you're able to elect to treat all your interests, all your activities as one single activity as a real estate professional. So when you're out there and you're acquiring these properties, that's something that you're going to have to track as you go forward. But that's the real benefit of owning real estate, is getting that qualification as a real estate professional. And to Duane's point, soon as we know that a person meets that, on page 2 of that tax return, we put real estate professional. So the Internal Revenue Service knows from the get-go what we're doing, what we're deducting, and why we're doing it. And it doesn't raise any red flags doing it. In fact, it actually helps you to label yourself that way.
So Jim, just put a little color on it for NEI and brokers in general. A broker, an active real estate broker that does not own real estate, do you think they qualify as a real estate professional? Because there are different opinions out there.
Well, they have to own more than 5% of the entity in which they're performing.
So if they own 100% of their own entity, do you think then they qualify?
Yep. Yeah.
Yeah. And so you check with your CPA. There's different opinions out there about real estate professional if you're just a service provider in the industry versus an owner.
Hey, Duane, can I chime in?
Oh, yeah. Oh, hey, Todd.
Rock and roll. Hi.
Welcome, Todd
All right,
Phillips.
sorry,
Todd,
Todd,
why don't you
tax
introduce
attorney.
yourself? I know people on the screen can see you. Todd's in Minnesota, one of our tax experts. But go ahead, Todd.
Sure, yeah. I'm a tax attorney by trade. I worked with Jim back when it was a different decade, and Duane and I have known each other for a long time. Tax strategies are my thing. I'm also a CFO of the company that puts on these events, RE Journals. We do like 150 events a year, so I've been on the Zoom a lot, but I appreciate being here, so thank you. Just real quick, on the real estate professional thing, if you want to get in the game and you want to be a real estate investor and use tax shelters, you got to be a real estate professional. Brokers, if you go right to the IRS document that says real estate professional on the top of it, and you get to like paragraph 3, it says brokers qualify. So to me, like you reading the tax code, which I enjoy doing, but not many other people do, it's complicated, and there's ins and there's outs, and there's all these tests and things that you got to do. But it's pretty clear in an IRS document, says real estate broker. I like to rely on that. If they said it to me, it's probably not, Jim will be like, that's probably not the ultimate authority. But it's pretty good if you're going to end an audit and you're like, hey, well, here's your document that says brokers qualify. So that's my professional opinion. I'll jump in on the other stuff later.
Can I add just one more thing? So, if you're working, if you're starting out and you're not more than 5% owner, and you don't want to be W-2, say, would you consider give me a 1099? If I were starting out and I didn't do it, I would see if I could form my own S corp, possibly, which I'd own more than 5%. I'm a real estate broker, right? That's a trader business that qualifies for that. And now, will my employer issue me a 1099 for my services? And now I can become a real estate professional, right? And I can do it. And I'm not married, so I can go out and start acquiring buildings and taking all the advantages that you can by owning real estate. So that's a possible technique, and we've helped some people do that. But again, that's up to that individual company, that yes, we will do that. Some folks don't like to do that, but if you have one that's willing to do that, that's something to take a hard look at doing.
Let me try to summarize it because we've gone around in circles a little bit. So in its simplest form, NEI brokers are real estate professionals. I think, and we work with a lot of appraisers, attorneys, accountants, just different people that touch the real estate space. And I would tell you a lot of those people don't qualify. But here's the group that doesn't qualify that Jim's talking about. If you're a W-2 employee of a real estate company, you can even be the CEO of one of the major brokerage firms. If you don't own 5% of that company, you're not a real estate professional. Right. Okay, so for anyone here that's a W-2 employee, Jim's technique around that is you do set up your own S-Corp and you own the S-Corp and get your S-Corp active in real estate. But in general, most W-2 employees, like all those people that work for public REITs that get a W-2 paycheck, they're not real estate professionals under the code. Even all they do is real estate. So this is a big deal because it leads into what's next. Once you're a real estate professional, which most of us are here at NEI, how you can start sheltering your 1099 income. So let's go, Ryan. We've already, unless people have questions on the professional designation. Yeah, Michael, go ahead.
So let's say that somebody's a W-2 employee at a firm and they make $100,000 a year. Can the company issue them $20,000 of that separately as 1099 income versus W-2 if you qualify? I guess that's a Jim question.
So the question is, bifurcate between 1099 and W-2, a little bit of a legal opinion. I'm not sure if I'm the one to answer this one.
I'll let you answer that.
Yeah, I'll kind of.
Yeah, don't do it.
I'll kind of
Don't do
answer
it because
Okay.
Hey, Todd, go ahead.
yeah, IRS isn't going to like it. They're going to see that W-2 and assume that that's a full-time job. So now you've got a factual battle on your hands. The last thing you want to do is get into a fight with IRS over the facts and circumstances. So if you're going to get your ticket into the game, do it, go all in and make an S corp or an LLC.
Yep.
Be 1099.
Yeah,
Or your spouse.
Yeah, kind of.
Make your spouse a property manager.
Kind of the test on whether you're a W-2 employee or can you be a 1099 is, is your boss telling you when to show up? Is your boss telling you how to dress? Is your boss telling you, giving you everything that you need to perform your job? I'd imagine a lot of, guys and girls in the real estate industry, probably don't necessarily have that. They're kind of not coming and going as they please, right? But you're out looking at properties kind of not under the thumb of a boss. So I think that most people probably in this room and most of your employees, if we want to put that in quotation marks, would probably be able to go 1099 and there'd be no issues with it.
If I can just make one final point. So we're talking about S corporations here, and Zurab did an excellent job going through the different ownership structures for real estate. So when you're starting out and you do form an S corp, that's not for owning real estate. You do not own real estate in an S corp ever. So that's for your services income. So you want to own real estate in an LLC or a partnership or a pass-through entity for a number of reasons, one of which is tax basis. And so when we get into what Ryan's talking about, that will allow you to maximize your deductions. It doesn't trap value inside a corporation that you may have to pay double taxes on. So please do not own real estate in an S corp. I'm trying to help a very wealthy family in New York right now unwind an S corp in which they've owned real estate for some time. It's a mess. So I'm just saying, don't ever do that.
Okay, so now we're a real estate professional. We got past that side. And the Tax Cut and Jobs Act that was passed in December of 2017, candidly, it was, I don't want to say a gift to real estate, but real estate has favored nation status under the code. And favored nation status in that it's a deferral tool and a sheltering tool. And one of the provisions that was passed in that Tax Cut and Jobs Act has to do with depreciation benefits and how we as real estate professionals can use depreciation. We call it bonus depreciation. And so Ryan's going to dive into depreciation, how you can use it as a real estate professional to offset your income, and talk a little bit about what's called cost segregation studies. So Ryan, why don't you jump in and talk about how the system works, and then we'll give you some case studies.
All right, thank you, Duane. So cost segregation and bonus depreciation. As Duane mentioned, the TCJA effectively spiked bonus depreciation to 100% for the last 5 years. Now, it's starting to sunset. 80% this year, going to sunset 20% every year after this. I think the next slide actually has the numbers. Okay, perfect. So another change brought on by the TCJA was it also allowed for bonus depreciation to apply to acquired assets. Previously, it had been only initial use. You're only really looking at new construction. Whenever things are built, renovated, it would qualify. Now you're also looking at acquisitions, which has been, going from having no bonus depreciation on acquisitions to 100% for 5 years. Was obviously a substantial change. Now that it's sunsetting out, there's some other considerations to think about, such as qualified improvement property, which had also been somewhat, kind of almost redefined within the TCJA. We'll touch on that a little bit later, but now, it's not quite as simplified anymore where, you have everything from 3-year to 20-year property for the most part that would qualify. Now, there's more incentive to kind of dig a little bit deeper and break it out further. We can go to the next one. Thank you. So, cost segregation. In a nutshell, it's ultimately breaking out real property, which is either 39 years, depreciated over 39 years, or 27.5 if it's residential, and trying to move that to a shorter life category, such as 3, 5, 7, 15. Those are kind of the most common ones. There's other specialty classes, but for the most part, 99% of what you're going to see is going to fall within those buckets. Breaking it down, it's not essentially, you're not just looking at like FF&E, you're looking at different mechanical and distribution systems. Depending on the type of property, you're looking at electrical loads, plumbing, HVAC. In kind of the most basic sense, cost segregation is breaking down a building or a property and looking at what's not essential by the IRS definition to basically operate that building. You need 4 walls, you need a roof, you need basic electrical and plumbing to service bathrooms, HVAC just for general human comfort, but everything outside of that, everything additional, if you have above and beyond what you need in terms of like electrical systems for computer equipment, just looking at like simple offices or like kitchenettes, things like that, different cabinetry, all those assets can be reclassed from a real property life into a personal property. And then, further, you're going from 39 or 27.5 to 5, 7, 15, and then that would qualify for bonus depreciation. So depending on the size of the property, it can substantially front load the depreciation in year 1 and years 1 through 15, rather than straight line over that entire long period of time. So benefits. I know we just touched on this a minute ago, but you're effectively looking at an immediate increase in cash flow. Deferral taxes, it's the offset taxable income. And one, I guess, less talked about tool here is, and this is something that Jim and I see all the time in speaking to clients, we'll perform a cost seg on an individual acquisition or new construction project, and they'll say, this is great, I wish we would have done this on, some of our projects in the past. Well, you can. Through means of basically a change in accounting method, a 3115, you can go back and depending on, net tax basis, if there's still basis within, maybe we'll say like just an arbitrary example, but a retail property that was acquired 10 years ago, you can go back and you can basically catch up on that depreciation that you should have been taking. We can go back and we can break it out and say, this is a $10 million project. 30% of this should have been allocated to personal property classes. You've been depreciating the straight line. Let's catch up on that, depreciation in this taxable year. So you can, you might get a $2.5 million, $3 million increase that you're in depreciation that you should have been taking in a permissible method, and you'll catch up on it in that individual year. So it's never too late unless it's effectively fully depreciated at that point. So unless you've been holding a property for 40 years, even going 20 years out, it's still pretty effective for the most part. Other considerations. So qualified improvement property. I'll go through the definition real quick. So effectively, it was consolidated. There was a handful of different specialty classes throughout that had been introduced throughout the last 25 years, like qualified leasehold improvement, qualified restaurant property. I'm sure some of these might jog your memory, but effectively it was all consolidated into qualified improvement property, or QIP, and it, for the most part, the definition is any any improvements that were placed in service on the interior of a building after the shell of the building had been placed in service will qualify for 100% bonus depreciation and a 15-year life. So a lot of taxpayers have really taken advantage of this. I just worked on a massive retail complex where effectively they constructed the shell of the building, and then all the tenants moved in, and they paid for the fit outs of those spaces, and they were placed in service 3 days apart. As long as it's not placed in service the same day, it could be the next day, then you can qualify for this class. So it's really incentivized renovation projects and basically any revamp of an interior space. And the rules on it are fairly broad, as long as you're not touching the envelope of the building, so the windows, structural components of the roof, you most likely will qualify. So, we can go back one step, sorry Duane. One thing to consider here is, it's a bonus depreciation eligible class, it's 15 years. It was kind of a catch-all in the past. It was fairly easy to, you're spending however much on a renovation of a space or an office fit out, just throw it all in QIP and you're done. 100%.
Recording in progress.
And now there's a little more incentive to, if you're going to get a cost segregation performed, you can move that from 15 years into 5 and 7. So if it's not fully depreciating, you're getting 80%. The impact isn't going to be quite as great this year or next year, but as bonus really starts phasing out and you're down to 40, 20, 0, and obviously 0, it's going to be the difference of you're moving them to these different buckets. You can fully depreciate an asset over 5 years rather than 15 years. So now there's more incentive to actually consider this, which in the past we just told some of our clients, just throw it all in QIP and you're done with it. There's no reason to dig into this further. Another thing to think about, sorry, Jamal, I know you want to jump in here, is partial dispositions. Usually, most quality studies will break out, how much of a basis of a building is going into like electrical, plumbing, the actual structural components, roofing, things like that. And then down the road, if you have to, strip off the roof and replace it and capitalize that cost, you'd be effectively depreciating 2 roofs. So partial dispositions help by allocating basis to a particular component, so you can just write off the remainder of that component, so you're not effectively doubling up on your, on the assets that you're depreciating. So, did you want to jump in? Oh yeah.
Oh, sorry, excuse me. So just a couple quick comments. So as Ryan said, the bonus, they're going to be phasing out over time. Administrations change, laws change, right? It may come back 100%. The next administration may very well likely change that. It all depends who gets in. So it is still important to do a cost segregation study, because even if it stays in place and it phases out, you are moving a substantial portion of your assets from 39 years or 27 years down to 15 and 5. You're still accelerating deductions. We all got a little spoiled because it was a 100% bonus, a beautiful thing. But you can still do it, and you can still go back to properties that you haven't done cost segregation studies on and catch up the benefits that you haven't taken. And it's called 3115, it's an automatic change, and that provides a substantial benefit as well.
Okay, Ryan, should we show a few examples of how brokers can use
Absolutely.
Depreciation? So why don't we walk through one of these deals?
Sure. So this is actually based on a deal I did a few years ago, and I changed the bonus just to make it a little more real life example. But effectively, a portfolio was acquired of car washes, gas stations, and convenience stores. So there's certain asset classes that are kind of all-encompassing that would qualify, the entirety of the basis would qualify for that asset, and a lot of those, if it does qualify, are bonus depreciation eligible, so that's obviously beneficial. You want to get as much of that as possible. So in this scenario, the first part of any analysis is this is an acquisition. You're basically breaking out the intangibles. You're looking at just the tangible cost being the building, improvements, and the land. Can't touch the land. IRS has, there's been a bunch of court rulings on this, and it's non-depreciable, and the means to actually derive that land value is also a little contentious, so you want to make sure you're going about the proper methods to derive that value. But effectively, you're left with the building and improvements, everything that's going to depreciate. It would effectively default to a real property, so you're looking at 39-year. From that, we'd come in, we'd break out, what's allowed, what's permissible under the 5, 7, 15-year property under different asset classes, and then from there, that would all qualify for bonus depreciation. So in this example, you had $46.6 million that was basically the tangible assets aside from the land. And then once you break it out into 5, 7, 15, which was the majority of it, because a lot of these assets will qualify under basically distribution of petroleum products, being gas stations, or if there's like a Jiffy Lube or something like that, then you can qualify the entire thing as a specialty asset class that would qualify for bonus depreciation. So in the long term, you're getting over $28 million of that depreciation year one of your investment of 46 and change. So it's really worth exploring this. Just because the immediate returns could be very substantial.
And just a little NEI color, because we call these 168 DSTs. 168 is the code provision, and this is our most popular product type, C-stores. And really, to Ryan's point, if you look at this deal, 55% was written off the first year. And if you do the math, what we don't have on this, let's just assume you put 25% down and had a loan for 75%, so it's a 2x on your equity. Put in $1, you get $2 of depreciation back, put that on your tax return, guess what? It's almost like a tax-free investment if you can shelter it. So we do a lot of C-store DSTs that have nothing to do with 1031s, and we sell this product the last 2 weeks of the calendar year, it flies off the shelf, because that's when people give us a call. Because they're like, Duane, I need some depreciation, what do you have? So we own several convenience stores. Another asset class that we like is car washes, because there's some good credit car washes out there now, and they sign 20-year leases, and they're bite-sized deals. You can buy some of these car washes for $1 million or $1.5 million. So NEI brokers, pull together 2 or 3 brokers, go out and buy one of these $1 million assets, and depreciate 70–80% of it the first year. If you need any help with it, just let us know, because we got the whole structure set up. The other beauty with our program is you can just buy a bite size of one of our DSTs. Okay, so a lot of the NEI legacy brokers, they put 25 grand into our 168 DSTs just to shelter a little bit of their income. But this is the product du jour right here, C-stores. We love this product category.
Hey, Duane, it's Todd, real quick. This almost all of my clients do these and have done deals with Duane, just for the record. And like Duane said, the last 2 weeks of the year, we're looking all over the country for deals. But don't forget what other things that will qualify. So fisheries, hog barns, marijuana facilities, anything that's a 15-year or 5-year property on its face qualifies for bonus depreciation. And I just want to add that this is the first time, Jim, we started working together in the 90s. This is the first time in our lifetimes, since 1986 Act, that you could invest $1 and get more than $1 return just in tax benefits. It's patently ridiculous that it's ever happened, and I hope it continues, but that opportunity is still there right now in 2023. So get smart about it and look at the other asset classes. It's not just gas stations and car washes. There's options out there.
So Ryan, this is a multifamily deal you looked at?
Yeah, so this is an apartment complex that I did work on years ago, effectively, rough numbers, but $75 million were invested within the actual complex. You have hard costs, you have effectively the tangible costs, and you have soft costs, architectural, engineering fees, permitting, things like that can actually be capitalized as part of the underlying assets that they pertain to. So after an analysis, we basically came back and we said, the basis that was shifted out of 27.5-year, the default kind of real property for residential classification, we pulled out $22 million into a personal property class, and going from straight line over 27.5-year to capturing 100% bonus in year one is fairly substantial. And if you're looking at, so step 3 is the 100% bonus that would classify for the 5, 7, 15, and then total year one depreciation, you're still capturing, the basically 1/27.5 of the depreciation for the remainder that's staying in 27.5 years. So that results to the 23.3 that you're getting in year one. So it's 31% of the investment. For the most part, you want to shoot for at least 20–25% is being reclassed to a personal property class. So that's not a bad starting point for especially a lot of these asset classes. And with some, going back to Duane and Todd's point, it could be substantially more. If you're looking at like manufacturing, things like that, where there's substantial cost put into the infrastructure to support that equipment, it could be upwards of 50%. And in some cases, like the C-stores and the gas stations, car washes, it can be 100%.
And here's just a rundown, Ryan, why don't you, just some of the product categories, and these are the ranges of cost seg studies and how much of the investment typically qualifies for first year write-off. So just to give you a feel, and my product category that I like the best as an investment is industrial. I've always been an industrial owner, and even my industrial buildings, I'm getting those cost segs up to almost 30%. Because guess what? The parking lot qualifies, the landscaping qualifies, the truck loading docks. So even industrial assets, you can get a pretty nice cost seg study. But these are some of the ranges, Ryan.
Yeah. These are a little more of the generic ranges, kind of asset types or classifications that you'd see. But it really doesn't stop here. I've done airplane hangars to riverboat casinos. It really any tangible property that you're investing money into. It can be, there's usually an opportunity for a cost segregation and to adjust how it's going to be depreciated going forward. But this is a little more general range of what we would expect. But in some cases, it can certainly exceed that.
So that's cost seg, that's depreciation. Again, in its simplest form, you take this loss, it works its way onto your 1040, and guess what? It shelters your 1099 income. It's a great tool. Go ahead, Michael.
So a question with regard to these cost segregation studies. I remember when we first started doing those years ago, we actually had to have an architect go through and do a takeoff of the building and go through every component and itemize it. Do we still have to do that, or is there better or easier ways to do it?
Yeah, that's a good question. So that was pertaining to if you actually have to go physically inspect a property. Most of the time, I would say, it depends. If you're looking at, you basically have two buckets. You have acquisitions, then you have new construction. New construction nowadays, I'll look through the actual engineering and architectural plans. You can basically get a sense of what's there, between all the renderings and the payment applications incurred by the general contractor or the subcontractors. You kind of know what's involved. That's kind of the best case scenario. On the other side, you have some acquisitions of, and I've done buildings that are 150 years old, and they have, the owners, they give me the keys and I'll walk around. They have no idea what's in there half the time, but the tenants are paying, still paying rent. So it really varies with acquisitions, especially dated ones. Historical buildings. Generally, you have to walk through the building and get an idea of what's actually comprising it. But with new construction, it's not quite as necessary to go out to the sites most of the time, just because the documentation is usually there.
But you don't have to have a plan or something filed. That's kind of your backup.
Generally, so there's like the IRS issued an audit technique guide. They have a lot of that basically laid out. We look at everything that's available, on the onset, and then from there. We'll document and we'll do the takeoffs, and we use different databases that are IRS approved methodologies. So there's generally no issues, and if they do have any questions, they typically just look through the report and it follows their guidelines, and they usually close the book on it.
Okay, so that's cost seg. Todd, are you still out there? We're going to turn it over to Todd Phillips. He's going to talk about some other creative techniques that brokers and professionals can use to create wealth. Todd, are you there?
Roger that. Thank you. Yeah, I really apologize. I wish I was there. This is my favorite event of all time, and some of my friends are in the room, but next year I'll be there. So thanks, Duane, for putting this on and moderating, and thanks to all the panelists. Really been looking forward to this all week. So I just want to throw out a quick caveat. Again, I'm a tax attorney for a reason. I used to be a CPA, and I like the fact that I can give legal advice and that I have attorney-client privilege when we explore some of these options. So if you're thinking about doing an S-Corp, and we do the math and it's complicated, all that stuff we have attorney-client privilege on. So these are things that we're going to talk about to spark conversations. You're not going to walk away with all of the answers today, because some of the, there's ins and there's outs to everything, but let's get some of these ideas on the table and allow everybody to talk about them when you go to the Cubs game tonight. Hopefully you have some ideas on how you can use them to do more, to build more. So that's the quick intro. I want to tell a story, I think. If you could flip the slide one more. And I'm going to start a story about a client that Jim Lockhart and I had, Jim, like 20 years ago. So statute of limitations has passed on this deal. But the client came in, and he was a property manager, and I think a broker. I'm not 100% certain if he did any brokerage work. But he had a building that he wanted to buy, and he had some investors. What he came to us for is he said, Todd and Jim, I just want you guys to look at my pro forma and bless it, because the investors want to know that somebody that knows what they're doing looked at the spreadsheet. And that's complicated for CPA to do. It's an agreed upon procedure, but we can do that. But, we look at the math. The math was good, and we started asking some other questions, though. So this guy is new to buying real estate with partners, and he's transitioning his life from being solely a property manager broker into being an owner and being part of that ownership group. And so this is fraught with all kinds of opportunities for everybody that's on this deal, and everyone in between who's done it or on their way to doing it. So we want to talk a little bit about whether or not, I think this is Duane's slide, so Duane, jump in if you have comments you wanted me to hit on. But the idea of thinking of life as a balance sheet, okay? So we know wealthy people build their balance sheet. They don't live off an income statement. So what you don't want to be doing for the rest of your life is trying to generate fee income, right? You want to build something that's for the future. So you want to take that, leverage what you know, leverage what you do, and build it into a portfolio of real estate, and now you've got something that can give you back. So we're taking income, we're putting it onto the balance sheet, and then we grow that balance sheet until it exceeds the income we could possibly make otherwise. So, and what we specialize in, Duane, Jim, and the gang, is using tax advantages to make that happen faster and better and not screw up along the way. So this client came in and he said, okay, guys, here's the deal. Everybody's putting in $1 million, and I'm not putting any money in, but I get 20% of the deal. And so what we want to talk about is throwing fees into a deal. We're getting syndicated equity in a deal, and what that means from a tax perspective. So Jim looked at it and he said, Todd, I think we've got a problem here, because the investors and the syndicator were not on the same page. If the investors put in $1 million and he's getting 20%, and they bought the building today and they sold it tomorrow, how many people in the room think that the syndicator should get $200,000 out of that $1 million? How many people think if they invested in $1 million in a deal and sold it tomorrow, they'd only get $800,000 back? Right? So he thought, the syndicator thought that $200,000 is mine. I'm getting $200,000 equity in the deal. And it's not quite that simple. And it's the same thing if you were to throw brokerage fees in a deal. So if you brokered this deal and your fee was $40,000, you're like, hey, I'll let that ride. I want to put that in the deal. Well, would you get that $40,000 back if it sold tomorrow? Different answer, right? Because it's a brokerage fee, you've already earned it. You should get that money back. Both of those things, however, Jim backed me up on this, both of those things have negative tax consequences. Okay, you would get something, the benefit of having that $40,000 or $200,000, but you don't have the cash to pay the tax on it. So we have to structure around that. We have to make a two-part structure to your deal when you go in. So you can't just go in and say, I'm going to throw the fees in. Here it is, give me a 5% stake in the deal, and we're good to go, because that's going to create a tax consequence for you. So one of the solutions we do there is you can turn that brokerage fee into an installment sale that doesn't have immediate tax consequences. And you take that other piece and we call that a profits interest. So that is where this person didn't quite understand how the world should work in an efficient environment. So if you're a syndicator, you're putting the deal together and you get 20% of the deal, most people say what you're getting is 20% of the profits. So if you put the $1 million in now, hold the building for 10 years, we renovate it, we get tenants, we do all the great stuff to make things happen, and our equity is worth $2 million. We made $1 million. You're getting 20% of that profit. Well, that's got a much more friendly tax, at least right now, and they've been threatening to make that miserable for all of us for the past 15 years, but it's just like a hedge fund then. So you're like a hedge fund manager. Now you're getting that preferred tax consequence. So you have to make sure when you go in and you do these documents that the investors and that everybody's on the same page. So drafting becomes really important when you're throwing fees in a deal or when you're taking income and putting it on a balance sheet. And so what I wanted to talk about here was when that makes sense and when you go from a broker fee to that 20% as well. So I don't know if you all have seen this slide that I have up on here before. I don't even really know where I got it from, but I learned this a long time ago, and I've done some development myself and investment myself, but there's 4 quadrants to making a deal happen. Essentially, you have the tenant and the user. So if you control the tenant, you represent them as their broker, or you know the owner, and they're going to it's the land in the building. If you're the one who owns the building and you want to get the tenant, there's 2 people that control it, or do you control all of it? Maybe you're already their landlord. Then there's the quadrant for money. If you don't have any money, but you have a land and you have a tenant, you can get a deal done, right? And then the last quadrant is knowledge. So as you build your brokerage and you build your empire and you build your career, the more of these quadrants that you can capture, the higher percentage of the deal you're going to be able to get for yourself. Okay, so think about how you're upstreaming. Are you just a broker right now representing tenants? Well, you can still get in a deal, right? You can take your broker fee and throw it in, or you can say, look, I've got a tenant who's looking for a build to suit. I'm going to be a partner in that deal. I bring the tenant to the table. If you can get the land tied up and the tenant, then you're all that much better off. If you can find the investors, so you have the money, the tenant, and the land, and the knowledge, now you're leading the deal. Okay, so Duane, did that meet what you wanted to talk about on that slide? Move to the next one. If you're talking, I can't hear you. So I'm just going to keep going.
Oh, you want here? You want this slide?
Yeah, we're good?
Yep, all good.
Okay, so key considerations here that I want to make sure that we get out on the table is if you're doing a brokerage deal and you want to use that leverage to get into the deal, where do you stand in terms of distribution and loss? So have these discussions up front. So if I put my $40,000, $100,000 fee in this deal, what's going to happen when it liquidates? Do I get my money back? Do I get a share of the profits? Do I share in the losses? What if there's a capital call? Have these conversations up front. And then are there tax consequences to doing that? Are you getting preferred returns? Do you have any voting rights? Do you have to sign on the loan? So I didn't talk about that, but the quadrant on money, the big piece to that in a lot of these deals is if you have a recourse loan, who's signing on the loan? And I can tell you the older I get, the more I think about it. When I was 30, the first loan I signed was like $11.3 million, and I didn't care. Like, I either lose it or I make it. But now that I'm older, I'm like, I got to retire pretty soon. I can't be signing on too many loans. But if that puts that deal together, I'll do it. I'd love to be there to do some Q&A and to see if what I'm saying is resonating. Does anybody have any questions? Maybe Duane can relay that.
So leaving the fee in the deal, any questions for Todd? Yep, go ahead.
Well, I think just an obvious one if we're all agents working on,
Here we go.
all agents working in an office with a broker that requires a certain percentage of each deal that we bring in. I would be interested in what other people have done. I know what I have done, but I'd be interested to know if other brokers just allow it to happen. You can take
What have
zero.
you done? What have you done?
Pull out the amount that they would get, and they take it, but I'm not taking it as income, but it gets paid to them, to the office, and then put my funds into the deal.
When you did that, did you structure it as a bifurcated deal? Did you structure it as part note and part profits interest?
Is winging it an answer?
Yeah, I think, so Todd, they bifurcated it to those that wanted the cash versus those that stay in the deal, I think was their solution.
Well, Jim, chime in, but I think you need to bifurcate that again and make sure that you're not getting an equity piece in that LLC that's taxable. You want to make sure that you've created a profits interest and that broker fee is protected in a different place in the document. Be happy to look and sort those out for anybody that wants help with it.
Yeah, Dustin and I just kind of commented up here. It's really important to get your legal documents drafted correctly. If you're deferring fees, putting fees in the deal, you want to make sure that you're structuring it in a way that if the IRS were to look at it, they would say, it's a taxable interest that you received. And so that's where drafting is so important, and each deal is different. So, you really got to be careful when you structure these deals.
Yeah, there's no doubt that the what's going to bind you is the contract or the documents that you drafted. I think me and Micah are kind of going through a deal right now together where we're just to the point now. We've been working on it for a couple months and just have finally nailed down the documents because he wants to be protected, I want to be protected, and we both obviously want it to benefit ourselves and benefit each other. So the most important thing when doing this type of deal is what the document itself says.
Yep, go ahead.
You talked about preferred returns versus profits for those preferred returns versus profits. If you want to talk about that briefly with the group.
Todd, you want it? Want me to take it?
We could tag team, but yeah, legally in an LLC, we want to call it a profits interest. It can be called a preferred return. One of the things I'm glad Jim brought up, S corps for real estate. Please, everybody in the room and everybody online, don't do an S corp without really good advice. Every time I do the math for a broker, it almost always doesn't make sense because there's other things we're doing that it affects it, and there's better tax benefits from doing something else. But the beauty of LLCs are it's like, to an attorney, it's like a piece of clay. We can mold it into anything we want. So you can, LLC membership interest can be whatever you dream up. So if you mold your clay into, you get 10% of the profits until everybody else gets to 8, then you get 12%, then you get 15, some kind of waterfall. You can, trade losses, you can trade depreciation. Some people get depreciation, some people don't. It gets complicated when you talk about substantial economic effect. Jim could write a book about that, I'm sure. But that's the great thing about all of this is it can be what you decide you want it to be with your partners. So if you want to waterfall it, if you want to have a pref, then somebody else gets something. In any format you can dream up, we can document.
Yeah,
What's your experience doing?
Yeah. So here's my business answer. It's at the end of the day, it's form over substance, right? So your $100,000 commission, we just changed the form of it, right? So that which you receive, whether it's a profits interest or an installment sale, that's not taxable today, right? If you get a 5% interest in an LLC, that's taxable because you got something of value. So it's form over substance. And Todd and Jim and we've done it before. All you're doing is just changing the form of your compensation. You're ultimately going to get it. We just call it something different for the IRS. And it's either a carried interest, which is the easiest way to do it, or an installment sale, meaning you haven't actually earned it as a performance-based. But it's form over substance, Todd, in its simplest form. And there are different ways to structure it.
Right, there are different ways, but to Duane's point, what you're doing is you're not picking up ordinary income by receiving your fee, you're turning it into capital gains or 1250 gains when the building is sold.
Which is one of the biggest benefits of the carried interest. Because right now a carried interest in a deal is capital gains, not ordinary income. So you're recharacterizing the fee as capital gains long term. So IRS has been trying to come after that. They haven't changed it yet. So, all right, more questions on this? Todd, go ahead.
No, just Congress has been after it every year since I was a kid.
Yeah. So that's the other beauty of it. You're changing ordinary income into cap gains income if you hang on to it for a year. Okay, more questions?
You're in the game. I mean, look, guys, the key to all of this, Duane, that everything everybody said is depreciation, is the fact that real estate is the only tax strategy left. There are credits and things that we can do that are creative, but if you're in the game, if you're in the real estate game, you are part of an elite club of people that can take advantage of the tax code. So you get in the game, you play the game, and you do it right, and you use bonus depreciation, which is a gift from God, in order to take and defer your income and use 100% of your income to grow your business.
Okay, yeah, question?
So would it be a great idea to hold off, like if you were to want to classify your LLC as an S corp until you reach that mark, that $60,000 mark that we were talking about, and you said that it would, you would want to get some kind of like consultation before becoming an S corp, right?
Yeah, you definitely want to speak to an attorney. And it's not necessary that you speak to an attorney in your area. You can be anybody, you can be Todd or myself, that can kind of run the analysis, but you want to know the laws in the state. I don't know where you're located. But yeah, and that's going to be, that's going to determine a lot of it is where you're located. But then, it's hard to just say in a vacuum, $50,000, that's the cap. We'd want to know, what the projection is, how income looks for the next couple of years. What do you think it's going to be? So there are a lot of factors. I wouldn't just say, yeah, this is a hard and fast rule. If you're 60, you do it. If not, you don't. So, just talk to somebody and try to give them, as much information as they need to make an informed decision.
And just to follow up on that real quick. So an S corp is to receive your service income for your services. If you defer a fee and you have an S corp and you want a profits interest in a deal, you're not going to own that through your S corp, right? Because now, as Duane said, you're converting that into capital gains. So you're actually going to get an LLC interest. Your interest is going to be in an LLC, and you wouldn't want your S corp to own that.
Yeah, I thought you were going back to like general questions, so I didn't know.
Yeah, that's perfect. There are other considerations, though. You're going to have to file a separate tax return. You're going to have to provide a balance sheet. I just did a balance sheet as a person, as a client that I would never take on as a client, but their friends and their former military. Their QuickBooks was a train wreck. I'm going to spend 20 hours fixing their balance sheet. Well, guess what? They got to pay me $500 an hour to fix their balance sheet. All their tax savings just went poof because of the other requirements of an S corp. The other one that doesn't fit with that, if any of you have kids that are under the age of 18, you want to employ your kids in your business, having an S corp means they're going to be subject to payroll taxes. Having an LLC means they're not. So there's that strategy goes away. So we might be able to save you $30,000 a year by employing your kids in your business, depending on how many you have and what you do with it. So it's really a balancing for every single person. There's just not a canned answer. You can't make a chart that says if this, then that. It's an art more than a science.
All right, any other questions? It's good stuff. We can keep going for a long time, but we're going to move to Florida. So let's do this. Thank you, everybody. And Todd, good to see you again. I'll see you in Minnesota in a couple weeks. So the Florida panelists, why don't you come on up? We're going to just keep this thing moving, given the time constraints. But thanks, everybody. Good stuff. All right, so we actually have a new lineup here of speakers. So everybody has a microphone. Let's do this. Chris, if you're okay starting, let's do the introductions, and then I'll kind of set the stage for the I'm moving to Florida panel. But Chris, why don't you introduce yourself, and then we'll go right down the row. Go ahead.
Jim in the first panel talked about the critical importance of hiring a QI, qualified intermediary, to help you navigate a 1031 exchange. He buried the lead in that there was a very qualified intermediary here in the room. I'm Chris Newton. I'm with Chicago Deferred Exchange Company. Call ourselves CDEC. We're part of Wintrust. If you're not from the local area, Wintrust is a Chicagoland bank. CDEC's been in the QI business for 30 years, been part of Wintrust for the last 4. I'm here with my colleague, Mary Cunningham. If there's such a thing as a celebrity in the 1031 world, Mary is our CEO and is a celebrity in the 1031 world. We'll both be available to answer questions. And my last comment, we're going to go through more of the why today than the what. So anybody that wants to talk about the mechanics and nuance of 1031 separately, I am absolutely available for a phone call or an email to kind of talk through what's going on in the world. And I hope that would be helpful. Thanks.
Okay. Yep. And we do a lot of business with Chris and Chicago Deferred Exchange QI work. And we're not going to dive into what's a 1031. We're going to do more. Here's how you use 1031 for residency purposes and creative tools. So, Eric, go ahead.
Well, thank you for having me. Again, Eric Fader. I'm an accountant as well as an attorney, and I practice law at the firm of Duane Morris. Duane Morris has over 900 attorneys. I do a lot of work with our Miami office. So the topic that I'm going to be talking about is, residency issues. Where are you a resident? What's the consequence of being a non-resident? With real estate deals, I help advise on transfer taxes as well as controlling interest transfer taxes when you're not selling the real estate, but selling the entity that owns the real estate, as well as bulk sale notifications, sales use tax, income tax for the entity, as well as the owners. So thank you for having me.
Awesome. Michael?
So you must be a lot of fun, tax accountant and attorney. Kidding. So
Stop it. Bunch of accountants in the room.
I know. So I'm Michael Hogue. I work with NAI Legacy as well. I work with Duane. He and I have been partners for, we're not supposed to tell anybody how long that is anymore, but a long time. I also do brokerage work there, and I specialize in investment sales. I've been in the business for more than 35 years. Again, I'm not going to tell you the exact date anymore, but just to give you a reference, I had a granddaughter that just turned old enough to drive today. And in our state, that's 16 years. So, yikes.
All right, Jeremy?
Is that all you want?
Go ahead.
Okay. Well, I specialize in working with 1031 investors. Mostly I'm taking people that are interested in taking their capital, selling something, and our team will help them with that side. Sometimes I do, but most of the time it's the team. And then I take them out and try to help them find 1031 properties or replacement properties, which are primarily, we're working with single tenant net lease properties, because oftentimes the people that I'm working with are trying to get rid of properties that have a lot of issues, and their lifestyle is changing, and they just want to get into something that's a little easier. Somebody said earlier, I think they said mailbox money. I don't think we call it that anymore, because everybody has an app, so they just wait until the thing dings on their phone and they know the money went into their account, and they're sitting on the beach. I work with a lot of our private clients, which we'll get into a little bit later. That's people that would invest with us or are looking for us to kind of marry up with them on investments. And I source properties for our DST program. So when we buy properties and syndicate them into the DST space, I'm one of the guys that goes out and hunts those properties down and brings them into our shop.
Great, thanks. Jeremy?
I'm Jeremy Larkin, CEO of NAI Miami and Fort Lauderdale, and also COO of NAI Skyways, which is the Tampa through Naples NAI offices. Commercial real estate brokerage firm. We also have an appraisal company. Basically, I'm here to just help walk you through, once you've decided to migrate to Florida, which is where a lot of you are going, I'll be the Sherpa helping you to tell you where you're going to go, why you're going to go there, and with the real estate investments.
All right, good stuff. Okay, so again, what the focus here is residency and taxation, and candidly, it's happening a lot in Minnesota. I still pay as a Minnesota resident, but trying to change your tax status from a Minnesota resident, Illinois resident, New York resident, to say a Florida resident, it's a big deal. It used to be as simple as 183 days divided by 365. That's all you had to represent, but those rules have changed. And Eric, why don't you kind of lead off and talk a little bit about residency considerations and kind of your experience in it?
Yeah, well, thank you very much. So I deal with a lot of high net worth clients, and I've heard many of them say, time for me to move to Florida. It could be the high income taxes in Illinois, it could be the real estate property or the property taxes, it could just be the weather. But as you mentioned, it's like, where are you a resident and why does it matter? One of the residency cases that, like you said, I'll just get a new place, I'll change my driver's license, I'll register to vote, is that enough? The answer is no. I mean, heck, if you look at the Illinois Supreme Court's decision in 2011, and this is one that I was real close to, the Rahm Emanuel case. He was running for mayor, and his residency was at issue. Because residency only isn't just an individual income tax issue, it's also where are you resident to get in-state tuition for kids that are going to college, or where do I get my homestead exemption, or where can I vote, or if you're Rahm Emanuel, it's like, am I eligible to be on the ballot? So the residency laws are state-specific. So if I were to tell you what Illinois, are you a resident, or New York, it's different state laws. And even within a state like Illinois, whether you're eligible to be on the ballot or if you're a resident for individual income taxes, different sets of laws. So that Rahm Emanuel case in 2011, the court said residence is ambiguous. It's one of the most nebulous areas. There's no precise legal meaning. In my area that I focus on, constitutional issues, double taxation, it's due process, it's commerce clause. So not only focusing on the statutes, the regulations, but our US Constitution. So what does it mean to be a resident? Well, there's really 4 issues that come to mind. One is, how do you acquire a new residence? How do you abandon the residence that you have here in Illinois to get out of it? Coupled with, if I'm a resident now of, say, if I move to a state that has an income tax, do I get a credit for taxes I pay to other states? And if you leave Illinois, and now you're no longer a resident of Illinois, is Illinois going to continue to tax certain income? And the answer is yes. And that's because as a resident, states get to tax you on all of your income. That's one of the things that the state of residency gets to do. And they'll give you a credit for taxes paid to other states if they think if the law allows for it. The non-residency states, though, will tax income based on source. So when we're talking about source income, what kind of source? Well, we're looking at wages. Well, for wages, I could be a resident of Illinois, but work in other states. And this is like you represented the Major League Baseball Players Association. High net worth individuals, their schedule is published, the government knows where they are, and they'll go after them for taxes. Same for those that are in my profession, like law or accountants that are doing timesheets. Almost all these businesses now require the workers to record where they're doing their work because the non-resident state will require taxes to be paid based on the amount of time you're there. For those that have clients that own S-corps or partnerships, you get a business that's multi-state. On the federal income tax, you get your 1120, 1065. In my world, state income taxes, the federal tax return is just a starting point. For business taxes, it's like a pizza pie. Every state wants to get their own slice of the pizza, and unfortunately, the way it works, sometimes there's more pizza taken by the states than is there in the plate. They'll double tax. They'll both tax the same items of income. And this comes up with, when you change your residency, some of the issues that arise, well, I'm no longer a resident of Illinois or New York or Massachusetts. What if you sell real estate and the person who you sold it to is also borrowing the funds, and now you're getting interest from the buyer? Some states will say, since the deal was sold in my state, even though you're now a resident of, say, Florida, we still get to tax you on your stream of interest income. What about an employee? And you get deferred comp. Some states will say, well, because you performed your services in the old state, you have to continue to pay income taxes to the state that you're no longer living in. That's also true with like the issues come up with covenants not to compete or termination payments. One area that's clear though is when Congress steps in. Back in 1996, Congress said only your state of residence can tax retirement income. So that's one good thing. So you know that if you've got a qualified plan and you move, Illinois would have, or your former state of residence would have no power to tax that income. How about the state of residency? When we're looking in a resident state, as I mentioned, it does vary from state to state. In our home state, Illinois, it can look at if you're here, just your presence, being in Illinois, for other than a temporary or transitory purpose, you are getting and enjoying the benefits of the government. Illinois says we get to tax you as a resident on all your income. But what if you're not here? There is another way that Illinois will tax you. If your domicile is here, your one and true permanent home. And that's where you get the difference between residence and domicile. They are not the same. If you have your domicile in Illinois, but are present in another state, and not just for a temporary purpose, Illinois will still tax you on all of your income as a resident. Now let's change the states, because I told you the laws differ state to state. What if I'm in New York? New York has 2 different ways to tax you as a resident. One, you've got your domicile there, your permanent place of home. That gives New York the power to tax all your income. They also, though, have statutory residence. You just have to have a place of abode, a second home. And if you happen to spend more, 184 more days in New York taxes you on all your income. So I've had clients that, well, their domicile is in Illinois, but they also have a second home in New York, and for whatever reason, they happen to spend too many days in New York. both states will tax you on all of your income. And the US Supreme Court said, that's permissible, no constitutional problem. We're gonna let both states tax you on all of your income. So getting an advice from an attorney, critical when you make this move. Make sure your clients get advice as to where their income is gonna be sourced and taxable. I've had some clients that say, well, I've got my business, it's closely held, it's in an S Corp or a partnership. I'm gonna move to Florida, and then I'm gonna sell my interest in the entity. And you think, oh, I'm selling stock, so it should only be sourced to Florida. Illinois doesn't get the power to tax it. Well, that's where we're seeing change. And on the next slide, I've got some of the things that, I'm sorry, the one back. Some of the things that you want to think about is, well, what does it take to actually change my residence? For that client that says, I'm going to move from Illinois or Minnesota to Florida, clearly there's some things that are obvious. Like, okay, I'm going to change my driver's license. I'll register to vote. Where I've seen some clients get caught is that they keep on claiming the homestead exemption in the old state because they still have their residence there or a property. They forget to, they maybe claim the homestead exemption in both states, and boom, the government's all after you. So there's a lot of other factors to look at, whether it's the amount of time, your connections with your doctors. But I also want to highlight the traps, things that are happening now. Some of these are COVID related too. I'll start first with, and if you haven't heard of it, New York's position, convenience of the employer test. You work for an employer that's based in New York, and your employer doesn't tell you to work in another state, you just do it for your own benefit, New York will still seek to tax all of your wages because you moved for your own benefit, not for the employer's benefit. Another trap is you sell the stock of the S Corp while you're in Florida, or the partnership interest. We're seeing states say that if you are an active owner of that business, we are treating you as unitary to that business, and the state that you're no longer reside in, some states now are seeking to tax a portion of that gain when you sell stock or you sell a membership interest. And there's court cases that came out last year where if you've got a tiered structure, an LLC that owns another LLC, and with that tiered, you've got, instead of you yourself selling it, you've got a tiered entity selling a pass-through entity. And the non-resident states are saying, we want to tax it. There was just a court case that came out last month. This was an Alabama decision. No change in law. But this guy, he worked for his employer, and the company was only in Alabama, and with COVID, he moved to Idaho. And he had no physical presence, no connection, but he was just doing his work, which he could do remotely from Idaho now. Alabama, a non-resident state with no physical presence, in a court decision, held that they could tax him on all of his wages. So these laws are changing. It's scary. And that's where you just want to make sure you get good advice, because you got to look not only at the state you're going to, but also the state you're leaving, to make sure that things are structured properly. And so happy to help with this issue.
Yeah, good stuff. And that's the point. Every state's unique. Find someone that knows the state laws, and Eric knows them very well. So Eric, thanks for all that information. So that's one thing, changing your residency. Now, Chris is going to jump in and talk about exchanging your basis. So i.e. getting your basis out of some of these states and using the 1031 technique to do it. So go ahead, Chris, why don't you jump into some of the 1031 considerations?
So we've spoken already that 1031 is a powerful tool to defer recognizing the gain on tax when you trade properties. Frequently, and I'd say even more so over the last 4 years, we've seen lots of people who are interested in moving from high tax states to lower tax states. Florida is just one example. It's going on frequently. I would say lots of people saying, hey, I'm moving out of Illinois and I'm going to take my money with me, and I would like my investment property to be nearer where I am. So something that we're facing. Important to note that 1031 it's a federal statute, right? So it doesn't matter if you're trading property and moving across state lines, but you're going to be subject to the taxation in the state that you move to and from. And let's go into the next one. And I would say this is an important caveat, right? As the QI, our job is to make sure that a taxpayer or an investor is effectively managing the process of trading the property and following this tax fiction that you're trading one property for another, as opposed to doing a taxable sale followed by a purchase. And as a consequence, we do that. We do the documentation. We hold the funds. Generally, we're not giving tax advice. I mean, specifically, we're not giving tax advice. We certainly know where rails are, and we're happy to talk to people about things to avoid. But I'd say the most common phrase out of my mouth is, be sure to engage your tax advisor in what your plans are and do it early so that you can prevent stubbing your toe on where you're going to move or what asset class you're going to move into. And I think this state issue is really top of that list on something that you need to consider as a taxpayer. Was it the last slide? Go back one more.
Yep.
No, go forward one more, sorry. I missed one. Yeah, well, I missed one, maybe in one of the earlier versions. There's a discussion in one of the earlier slides on this clawback provision, right?
Oh, yeah. There's a few states that are highlighted here.
Oh, it is there. I'm sorry. Sorry. Yeah, so this clawback topic, it feels relatively new. The example is you're a taxpayer and you own some investment property in California and you sell that property and you buy replacement investment property in Sun Valley, Idaho. When you go to sell that property in Sun Valley, Idaho, and if it's a taxable event for you, California is going to want to claw back their share of that. And this lines up perfectly with one of those topics that I would say, call a guy like Jim or call your tax advisor and figure out what the implications of that are to you if you've got a tax bill that's both in Sun Valley to the federal government and in California, and how you navigate those waters.
Yeah, we have, at NEI, because Florida, Texas, Nevada, Tennessee, we do a lot of deals in South Dakota. We just have a lot of clients saying, hey, Duane, take me to a no-tax state. I want to get my basis out of Minnesota. And so those are the states that are hot. Florida is always number one on the list. But we also have, of our about 200 clients, almost 50 of them are from California. We get a lot of 1031 clients out of the California offices. And clawback, so in California, they were the first state to do it, where you actually every year, even if you move out of California, you have to report that property that is now owned in Nevada or whatever state. And yeah, it's a clawback. And I'm just telling you, Minnesota, Illinois, it's coming. It's coming. They're going to have all these clawback reporting issues because for the most part, when you get out of that state, you're not reporting anymore. But these clawback provisions are somewhat new, and California was the first to do it. It's going to start happening. So if you have clients trying to get out of these high-tax states, pretty soon I think clawbacks will be in place for all of them.
Yeah, on that, I think with California, we dot I's and cross T's. You expect people to review your exchange when you report one, so California is definitely an area that you need to be aware of.
So those are some of the 1031 just in its simplest form, going state to state. Those are the no-tax states, obviously. And then an interesting technique, and I asked Chris to speak about it, that we get from some of our clients is, Duane, can I use my 1031 money to buy my vacation home or to buy what's going to become my primary residence? And the answer is yes. You have to be a little creative, but vacation home 1031s, we're seeing more and more of them. Now, we don't go out and buy the home for these individuals, but I've seen a lot of clients actually use this technique to buy the house that they ultimately are going to move into. So I asked Chris just to touch on it because it's kind of an interesting technique for states like Florida and Texas and Nevada.
It's real time. It's going on a lot. So first, make the distinction between a vacation home and a second home, right? So a vacation home, a second home in my mind is something that you use for personal purposes. It's not an investment property. As such, it would not qualify for a treatment under 1031. A vacation home that you want to use on a limited basis but have as an investment, you need to rent out. The requirement is that you rent it out for at least 14 days at a fair market price annually. And then you, as the owner of the property, are able to use it personally for the greater of 14 days or 10% of rental days each year. People ask me all the time, well, how's the service going to know how long I'm there or what? I don't know specific examples of people being audited on this, but you can be sure that if they're looking at something else and they want to make a point of this, they're going to check your credit card records, they're going to check your cell phone records, and they will know if you're in the area, whether or not you can prove that you're not in your second residence there, I suppose is up to you. But I think there are ways to kind of knock that down. So you have a second residence, it's an investment, you rent it out. Sometime after you've owned it for a few years, and again, Florida's a great example of this, you might decide that you want to convert that to your primary residence. So people own it, they rent it, they have it as quality for rental. You get to the end of the rental period and you want to move into it personally, you might do a full gut rehab, convert it to something that's personal residence worthy, different than maybe it was, and then you move into it. Provided that you own and live in the property for 5 years, you now are treating it as your primary residence, and there's favorable tax treatment as such.
Yeah, so we've seen clients, again, we don't get involved in this business, but we've seen clients convert their existing personal residence into a vacation home and then sell it 2 years later. A lot of California people have done that because there's so much appreciation of their homes. So they use that as opposed to their personal resident exemption. So we've seen it at both ends. Converting your house to a vacation home or buying a place, renting it out, and then moving into it, just the way Chris
I don't think it's a vacation home, but I know lots of people, and we've done a lot of deals over the last couple of years with people that owned condos when they first got married, decided they didn't want to sell when they were buying up into a bigger house, so they rent the condo in the city, and then 6 years later say, I'm going to sell that and I'm going to buy a rental place that I can use in Long Beach, Indiana, or Buffalo, or New Buffalo, or something to that effect.
Yeah, interesting technique. All right, good stuff, Chris. Let's talk about private clients and some case studies. I'm going to ask Michael to kind of hit on that because it's one thing that he works for NEI Legacy. I think this is another tool that NEI offices could use when you're helping individuals. But Michael, why don't you kind of walk through our private client program and how we've used that to move basis to other states?
Okay, so assuming that this taxpayer or client has followed the procedures you hear here, they've worked with an accountant that knows what they're doing, they worked with a tax advisor that knows what they're doing, they've got a qualified intermediary set up, then they get to me. And I'm the guy that's just the real world guy. And so what I'm doing is taking somebody who we would call them a private client because they're not interested in going into a massive 20-person or 30-person syndication. They just want to go do another deal, have me source it for them. And oftentimes they want to have me, oops, I lost my notes here, 1 second. Sorry, I don't know why it did that on me. They want me to source the property for them for two reasons. One is they know I can find good properties because we buy them for what we're doing, so we have these, this syndication model. And they also want to put money alongside of us. And so they'll say, hey, I've got $2 million, but I don't want to buy a $3 million or $4 million property. I want to buy a $10 million property. Can you guys go into something like that with me? And we'll do that. We'll, because we're looking for product and they have equity, which is something we never have enough equity. So yeah, we'll do that. So we'll go out and find a property. And I would say that most of the time they're involved in 1031 tax-deferred exchanges. They're selling something else or they sold something else and they're getting out of what we call the 3 T's, toilets, tenants, and trash, and they're getting into something a lot easier for lifestyle. I would say about 90% of my investors that are private clients are in 1031 tax-deferred exchanges in that process. I would also say that right now, 1031 tax-deferred exchange feels like to us that it's down 70% maybe from what it was a year ago because of all the other issues that are going on in commercial real estate. People have less deals getting done because of the implications of interest rates and cap rates being too close together, not having enough airspace. And so there's not as many sales, which then make the 1031 tax-deferred exchange happen. But I would say out of those people, they're usually going 2 different ways. And it really kind of gets down to who they are and how old they are, frankly. So if you're an investor that's older than me or my age and older, you can probably guess how old I am based on the color of my hair. You're probably going to want to get into something that doesn't have a lot of moving parts, and so that's kind of the single tenant, triple net lease, type product, Walgreens and C-stores and Advanced Auto Parts, those kinds of properties. And then they, going back to that map, I don't know, was that 9 states that are no state income tax states? They want to try to get in those states if possible, because if they live in one of them, let's say they move to Florida, but they buy a property in Nevada or South Dakota, they still don't have that tax implication unless there's some weird thing that's happening that I can't speak to, but they don't think they do, okay? And they've been advised that they don't. So that's why those become very popular. So they'll say, go source it there. And I'll go out and try to find the property, see if it fits our requirements as well. And sometimes we'll bring in a few other investors into it because we have a few of these several of these private clients that are always kind of waiting around for the deal. But they're not really syndicated deals. We're not taking them out to the broker-dealer network and selling them as securities. We're marrying up a few investors that we know and say, here's a deal, let's get in this thing together. It's kind of like if five people sat around, watching a Wild game. Well, maybe not the Wild because they played pretty poorly last night. Sit around watching a hockey game and they can make a decision like that. Hey, let's go out and buy something together. It's very similar to that, and that's how we treat them. We kind of go through this process of, hey, you're my partner now, and that's where you see we source the properties, we help procure the debt. We actually go out and find the debt because we have great lender relationships that they might not have. They may have held a property for 40 years and haven't really talked to a lender about real estate. We help go through the due diligence. We've got due diligence teams and companies that do all of that work for us, and they give us, great property condition reports and environmental studies and all of that. The disposition side, it probably should be on the bottom of that list as well, but the disposition of their first property sometimes becomes something we do. There's a bunch of our brokers are back here, and if it's something that they can help them sell, they'll help them sell that. We don't have to. It's kind of like we didn't get that assignment for leasing because we're not always the right person for it, but we can help them with that. And then after we buy a property, we do we've got accounting services and asset and property management for that property, because even a property that's single tenant, net leased, there's still things that have to be done. Somebody has to kind of oversee that the tenant's, performing their obligations, that the taxes are being paid, that sort of thing. You got to watch that, so there's asset management. And then if it's a property where we can help them lease it. And I guess that's kind of the big thing about what I wanted to say here is if you're an NAI broker, or really any broker out there, we reach out to you guys, or to your teams, because we can't do all this from Minnesota. We got 3 or 4 offices in the country, but most of our brokers are in Minnesota. I can't go out and help somebody lease a property in Florida. So I'm going to reach out to, like his team. The other thing, and I think it came up earlier that I want to just emphasize, and this is probably my last point, is that we have really no way of finding what we call people that want to sell without selling out. So if you have a client who's got a property, but he wants to hold on to 25% of it and sell 75% of it, there's no way I'm going to find that person. But you can find that person and then introduce them to us, and we can take down that 75%. And it's a kind of an off-market kind of deal at that point. And then to Duane's point earlier, we get 10, 20, maybe 15% discount off of that because we're not buying the whole property. And so that works for our program. And then the other thing is we do see people that are sort of in a different phase of their life. There's some people that are younger and they're willing to take more risk, and they'll buy properties. They want to buy properties that have more moving parts, or they have value add components. And that's just a different person. And so that might be that we've just got to merge them with somebody out at one of your offices, help that person buy that property, because it's not a single tenant net lease. It's not a commodity, and they're willing to they have a little more runway in their life. So that's kind of what happens. And I brought this one thing up. This came on Sunday. I see this email came in through LinkedIn. This is an old client that I had years ago. Helped him buy a bunch of single-tenant, triple-net properties and some multi-tenant properties because he was younger. Now he's 73 years old. I called him up maybe 2 weeks ago because I had the idea that I got to start calling my database. I got to keep in contact with people. I have so many people. It's like, reach out to them. So I reach out to him. Hey, how you doing, John? Blah, blah, blah. I'm not going to tell you his last name. Everything's great. I'm living in California. This is great. But hey, I might want to sell my properties in Minnesota. I marked that down. I got to get back to him about that. Let me think about it. And I get this on Sunday night. I was hoping to follow up, and he calls it churning because I help him sell and buy, so he refers to as churning. But it churned some of my Minnesota properties and the net lease properties located in non-estate tax states like South Dakota, and he's obviously thinking Florida and so on. So that's happening. I mean, as we speak, this is the real world that I'm living in, and this is what we see all the time. And I bet you we have a whiteboard in our office, or we just changed offices, so it's not there anymore. But I think we had somewhere in the neighborhood of $80 million worth of private clients just kind of sitting in the wings waiting to get into other deals. And that changes all the time because they might fulfill their requirement, or we may sell them something or go into something with them. But that chart is always changing because we have these people that are coming into us because of what we do is becoming well known. And I'm just saying to the group here, if you're a broker somewhere else, we can probably work together because you probably have those kinds of people. And if they want to get into a DST structured deal, there's other people out there, but we also are out there and we can help. So that's my...
Yeah, and the point, just to close it, and then we'll hand it off to Jeremy, this private client business, something new we came up with a couple years ago, and it's exploded. I mean, we've probably done 80 or $90 million of private client deals, and it really starts with this map. And we just share with them, we could do a made-to-order, and we have boots in the ground. What state do you want to be in, and what do you want to own, product type? And then we just spin the Rolodex and start talking to NAI offices. So this has been a big fee generator for our business, and one that we hope we can get other NAI offices involved in. It's been a great tool, and state number one has always been Florida. So I asked Jeremy to join us today and just give us kind of the rundown of Florida. He knows it better than anyone, and so Jeremy, why don't you take it away and tell us what's going on in Florida.
Well, you've made the decision to move to Florida. There's 22 million of us. Welcome you to our state. It's amazing how many have come in the last 2 or 3 years. We have 10 offices, 22 offices, 10 different ownership groups, approximately 250 brokers spread across the entire state from the Panhandle down to Miami. Next slide. Migration patterns. Historically, the Midwest has always migrated to the west coast of Florida. The Northeast and the Mid-Atlantic's always come to the East Coast of Florida. In the last 2 or 3 years, the patterns are still continuing. Of the top 10 metros you can see there, Miami, Tampa, and Orlando drew from New York, and then Cape Coral and Sarasota drew from the Midwest. Now, the interesting switch is the Northeast is now starting to shift to the Southwest. And we're listening to a lot of New York and a lot of New Jersey accents in Fort Myers, Naples, and Sarasota. Next slide. We added over 1 million people in during COVID. That's over 1,000 people a day. And we are slow, I mean, our growth is slowing because our numbers are getting bigger, but through the next 10 years, we're going to be averaging about 700 to 800 people per day moving to Florida permanently. Next slide. Thankfully, because of that, we're going to have a net positive population growth. If you look at the trends, especially since 2019, our organic growth rate was actually negative because we had more deaths than births, and that's pretty much baby boomer related. And it's going to continue that way for the next 10 years, however, because of the net migration coming in, and that is both domestic and international. We're going to continue to have positive population growth and stay above the 1% growth per year. Florida is very unique in the fact that it's becoming very Hispanic. And when we talk about Hispanic in Florida, it's very unlike the rest of the country. Most of the Hispanic population that spreads from California east is mostly Mexican in origin. In Florida, that's not the case. Largest group is the Cuban population, which came over from Cuba from the 1960s, then again in 1980 when the Marielito boat lift and Castro lift let out everybody from prison, et cetera, that came over that wreaked havoc in Miami for a good 10 years. Puerto Rico has led a huge growth of 700,000 plus, which came over in the last 3 or 4 years principally. And they pretty much have settled a little bit in South Florida, but they tend to move to the Orlando area. The southeast portion of the state is driven heavily by Cubans, but also mostly South Americans, Argentines, Venezuelans, Colombians, Guianans, which there is Guyana in South Africa, a lot of Brazilians, and from the Caribbean. And total Hispanic population is now approximately 27%. However, the real concentration is still in South Florida, principally Miami, Fort Lauderdale. If you took these 2 counties out of the state, we'd look very much like the rest of the country, Connecticut, Illinois, whatever, with the same demographic profiles. Once again, here's the heaviest areas where you can see the heaviest concentration of Hispanic population. Miami is actually 82% Hispanic. There are a large number of areas in Miami in particular, and it's moving that way in Fort Lauderdale and Tampa, where they speak Spanish first, and then they'll flip to English. You don't have to speak Spanish, but it is very helpful. I don't, and I've gotten by pretty well, but it would be a real big positive. Our economic engines, we don't manufacture anything other than smiles and fun and beaches. So for you to come, basically, leisure and tourism is huge, education is growing, and everything else is pretty much intellectually driven. Next slide. Small business startups, most of the time when you decide to quote unquote retire or relocate, you're not doing it to come work for somebody else, you're doing it to come work for yourself, which is why we have such a big boom of small business startups. Next slide. So everyone thinks that Florida is very homogeneous. If you take I-4 runs from Tampa to Daytona Beach across the state, that's pretty much the dividing line of the first two portions of Florida. The colloquialism is you go north to go south, and you go south to go north. The northern half of the state very much looks like Southeast United States. Politics, personalities, profiles, etc. The Panhandle, which is also referred to as LA or Lower Alabama, tends to be heavily driven by the Alabama-Mississippi markets, a lot, basically heavily tourism. Tallahassee, they put the state capital up there. We have no reason why, but it's been up there for so many years. About 80 to 85% of the economic engine runs from Tampa and Orlando south through Miami. The other interesting issue is the majority of the population nests along the coast. The only place where it really is heavily is from the I-4 corridor from Tampa to Daytona Beach. The reason for that, for the most part, is in the Panhandle area, in the Big Bend, it's mostly rural and inaccessible. In the southern part of the state, you see the huge lake, which is Okeechobee, but the rest of the interior is the Everglades. And the Everglades runs from Lake Okeechobee all the way to basically about 300 yards south of my house, where it flows out into Biscayne Bay and into the Atlantic. Entire state is 500 miles long and about 80 to 90 miles wide. Miami, Fort Lauderdale, if you're kind of taking a look at it, Miami's 14 miles wide at its maximum point. So if you think about that compared to Chicago and try to put 7 million people, which is what the population is from Palm Beach to Miami, that's sticking a whole lot of people in a very small area. And we don't have the mass transit yet. We're working on it. But the density, because of all the in-migration, is taxing most of the transit, and most of pricing is going way, way, way up. So shifting from that to the real estate world, if you're looking to make investments, if you're looking for aggressive cap rates with mostly very high growth rates, you want to stick to the South Florida market, Miami, Fort Lauderdale, and possibly Palm Beach.
What do you mean by aggressive?
Very low, with rates that are going to be moving very, very quickly. If you're looking for stability and higher cap rates, you're going to tend to move up into the central part of the state, southwest part of the state, or up into Jacksonville. The big boom area right now is the I-75 corridor that runs from Tampa down to Naples. It then turns and cuts across to Miami, Fort Lauderdale. That area is booming. Prices are probably doubled. Cap rates are starting to get a little bit more compressed and more Miami-like. And a lot of the investors and developers that are in South Florida have moved to the southwest coast, principally in Tampa, but also along the Sarasota, Fort Myers area, especially in the multifamily area. Economic engine on the west coast is driven principally out of Tampa, and then it drops off very dramatically because it becomes more residential based, and still a lot of second home folks. I know there's a lot of NAI executives and professionals I work with up in the Midwest. Most of the time when I'm calling them, they're somewhere between Estero and Sarasota. Estero is just north of Naples, by the way.
All right, good stuff. And Jimmy, just give a little color on cap rate trends the last year. Middle of the fairway, net lease deals, which is the number one product we're asked to acquire. What do the cap rates look like over the past 12 months, just out of curiosity?
Well, I'll break it into two pieces. Pre-Fed move, cap rates for the best triple net products were probably sub 3 to 4. And then moving up to 5.5 or 6 for like the triple B, double B rated product. Now we're seeing divergence, and we're seeing cap rates starting to move up 100 basis points, 150 basis points, but we haven't seen enough sales where it's truly consistent. We've seen a lot less activity.
Okay, yep. All right, good stuff. Q&A for this
Duane,
panel.
I have one more thing.
Oh, yep, go ahead.
So, I'm hunting for these properties, and my investors want to be in the no state income tax states primarily, but they're all, we used to call it the Sun Belt, all the way across the bottom of the United States. Now they call it the Smile States because they creep up the coast a little bit more on both sides. I don't think they include California. I think the Smile stops over there. But my read on it is that Florida, Texas, Tennessee, and even some of the other, some of the states that have taxes have lower cap rates than any other place in the country. So people are chasing that. There's a lot of demand for it. And so even though they're creeping up, they're still pretty low. I mean, if you're talking to your clients, they're not going to get a great cap rate by buying in Florida. It's going to be a lower cap rate, but they're going to be in a place that's booming and probably going to hold its residual value and probably even grow in value in the future.
All right, good stuff. All right, questions? Do we have any online questions, Spencer, or that we're aware of?
I don't think so.
Okay, all good?
Everybody to sleep?
Everybody good? All right. Hey, well, first of all, thanks to the panel here on the move to Florida, and and to kind of close out the morning, thanks everybody. I know we've covered a lot of different topics. Some of it's scientific, some artists, but anyway, I hope you learned something and hope we can do some business together. Just track down myself or any NEI legacy professional. We can put you in touch with any of the panelists, and let's make it a great day in Chicago. So thanks for joining us.